Friday? We on here? Are we on here? Let's see. Looking good there. Get this guy to pop out. Pop out right there. All right. Right there. Sweet. I think we're on. Our first ever 7 o'clock. Rob, Kevin, K Paso. First ever 7 p.m. one. Just got done. I just got a haircut, fresh cut by my beautiful. And you can see it looks good. Hey, Washington in the house. Mushkey. Right on. Mushkey Potamus. Actually, I got to do something here real quick on the oops. Just 1 second here. Let me go back to this. Maryland in the house. What's going on, Herbert? Hold on just a second. Let me go to here. I just got done watching the Dallas Renegades give up 5 turnovers. 5, man. Ugh. Against my Houston Roughnecks, but I was going for Dallas because I don't want one team to roll 4-0 and another team to be and all the other teams to be like, also rans. I don't think that's good for the sport. But it looks like Houston's going to end up winning. It's too bad. But hey, what are you going to do? Now the DC Defenders tonight are playing your Tampa Bay Vipers. So it'll be fun to watch that. I don't know if I will watch that actually because I get kind of tired. All right, let me go back to this. And when I get tired, I got to go to bed, which is why I'm starting to do these earlier because, like I said, after I do that, I get dopamine rush to do these live streams. And then when I'm done, I'm just kind of wiped out. So I got to say, it takes about an hour to decompress, so to speak. And by the time that happens, about 11 o'clock is here. And then I have to wake up early because Poopy Pablo. All right, hold on just a second. What am I doing here? I'm trying to get to, right, that's what I wanted. Hold on. We'll get it. Hold on. Right there. All right, cool. There we go. I think we are good, my friends. Let's see. Close out of that. I got too much time on my hands. Remember that too? Horrible. Styx was a friggin' awesome band until the 80s came along. Oh, yeah. Too much time. Some guys on here the other day saying 80 music was good. I was like, no, 80 music was bad. It was just all right. Coronavirus. So someone's asking a lot about coronavirus. My thought is nothing. I got no I don't have any thoughts on coronavirus. Don't much care, to be honest with you. It's just not a big deal. I think a lot of people are making a big deal out of that, and I'm just not worried about it. There's no other way around that. I don't have a mask. We went to a Georgia Tech baseball game with 3,000 other fans today. Not a mask on in the house. I know some people are saying when the warm weather comes, coronavirus will be kept at bay. I don't know that to be true because some of these places with coronavirus is hot, right? So I don't know if that's true, but at the end of the day, I'm not worried about it. Edmonds, Washington, right on. All right, we got Maryland. We got hey, right on, Mushkey. Southern California, Miss Denise, right on. Gary and Belva, hello, everybody. Daniel, bonjour. That means hello in France. Bilingual Josh, Long Island and Roberta, right on. I was watching Fleetwood and Steel rinse their balls on the 18th. No idea what that means, man. Checking in from your old hood in Phoenix. Where are you exactly, Kevin? We lived in McClellan and 7th Street, McClellan Boulevard and 7th Street. First, we lived on Camelback, 24th Street and Camelback, right up the street from the Catholic Church, like literally one apartment building from that church. That's where we lived, in some crappy little apartment building. Then we bought a house on East Monona Drive, which is 7th Street in Beardsley, way the hell up there. And then we lived on 7th Street in McClellan. So we lived 3 places in Phoenix. And actually, my daughter is getting an internship in Phoenix this summer. And she's actually getting paid pretty good money. So I'm going to drive her out there in May. It's going to be a lot of fun. And then I'm going to hang out a little bit and go see some old places I hadn't been to before. Does Tucson still have the minor league baseball team? When Charlotte and I first moved, is before the Arizona, not Wildcats, Arizona Diamondbacks were there. So we got to go see the Phoenix Firebirds, their last game in Scottsdale, which is fun. We actually saw their last game. Then we got to go see the Phoenix, the minor league hockey team in Phoenix. They played on the old Civic Center on the Avenue side. The Phoenix, I can't remember I think, whatever that, Woody Woodpecker, the other guy, Roadrunners, Phoenix Roadrunners, got to see them. That was a lot of fun. And then the Coyotes came, and then the Arizona Diamondbacks. So I'm looking forward to going back up there. I like Phoenix. It's too hot for me in the summertime. It's not natural in the summertime. It's something like South Texas. Young boys need to be outside in the summertime, and Phoenix and South Texas is too hot. My man Jordan, or Lady Jordan, says he or she hasn't watched in a while. Dude, I share with you the meaning of life, man. I'm not going to share it again. You missed it. California, Mary Beth, Cape Paso. Things have changed since last week a little bit. Michigan in the house. All right. Mexico, New York. All right. Pay off mortgage or invest. All right. Let's go into that here. Hold on just a second. We'll get this situated. Boink. We got to go here. Let's go over this. Pay off. Actually, I want to try something real quick. I want to see if I can't share. I want to share this whiteboard. Hold on just a second. Let's see if I can do this. And we're going to do, so if you all can see this, give me a thumbs up if you can see this whiteboard. I'm going to try to draw. Oops, I want someone to try right here. Can you all see that? All right, if you all can see, I didn't do it. I just see if you all can see that or not. So let me see what yes, it looks like you can. That is fantastic. I think you can see that. All right, sweet. I'm looking at my other screen there. Okay, cool, man. This is Zoom. I love Zoom. All right, so let me, I want to get at this now. So let's go to this, stop share. Yep, I can see it. All right, let me write something else here. All right. Tom Brady is the GOAT. Let's see, GOAT. GOAT. Just bear with me just a second, just practicing here. All right, sweet. All right, that's fantastic. All right, cool. So let me stop share. All right, I want to see if I can't, I've been working on some spreadsheets quite a bit, and I definitely want to show you some of the spreadsheets if I can get them here tonight. It's gonna be fun. I'm gonna do a video on them tomorrow, but all right, so let's go. So let's go. Pay over mortgage and invest. I've been thinking about this. Who asked me that? I forgot. I've been thinking about this. Hand claps. Hand claps and rock music. Not a fan. Too much. God. Styx was such a good band. All right. Okay, buddy. All right. All right. So what someone said, pay off mortgage or invest. All right. So Liette Mess. Here's the problem. All right. So we got the problem that we have with this. I've been thinking about this quite a bit, as a matter of fact. If you pay off the mortgage, that means you're putting more money down. All right. If you put more money into your home and don't have the liquidity, if you lose your job, all the equity in the world doesn't do crap for you. It doesn't. It doesn't do crap for you. I'm sorry. I mean, I think about this all my time. So let me give you an example for your buddy Josh. Last year, I made a pretty good amount of money, more than I have ever made in my life. It's nuts. And because of you all, I mean, no other way around that. It's freaking nuts. I love it. This year, I'm off to a better start, which is nuts. But the thing is, it could be fleeting. It could be just, the first group of people who found you like you and everyone else thinks, tells you go to hell. I don't know. But I have these fantasies in my head, I could double up my mortgage payment, right? Because I said, man, I could double up my mortgage payment and get done with that sucker a whole lot quicker than not. But then I started thinking, what if everyone hates me? What if everyone says, Josh, I'd rather watch Pablo take a dump than listen to your stuff. You know what I'm saying? What if? I don't know. I mean, see, at the end of the day, as a Christian, it's in God's hands. I just do what I can do, try to be as friendly as upstanding as I possibly can, knowing full well I'm a sinner and God will take care of the rest. But just because God takes care of the rest doesn't mean it's going to be to your benefit. We just don't know. So I sit there and I say, okay, if I was to double up on my mortgage payments, that's great. But what if the income stops? What do I do then? You know what I'm saying? What if I have any money? I have an IRA built up. That's nice. I have my M1 account built up. And when I say built up, I'm only 49. So the IRA is a bulk of my money. I'm down $20,000 over the last week time. So that's, like I said on a video I did the other day, that's like maybe 15,000 bucks. Yeah, 15,000 bucks. That's a number of mortgage payments right there. So all the equity in my home, and I've been paying an extra 800 bucks a month on my principal. All right, which is great. I like having that principal down. I have this nut I want to crack in my head for the principal being down. But if the income stops, then I don't care if you have 100,000 equity or 150,000 equity. You're not getting it. You're not. You can't go get a home equity line of credit if you have no income coming. You can't. You can't. You can't do a reverse mortgage because you're not 62. And even if you could do a reverse mortgage, there's still limits on how much you can get right out of the gate. You can't. I mean, you see what I'm saying? So the issue that I contend with is I hate debt more than anything, but I am a realist, and the realist says you could be up and down on your income, and if your income fades away from whatever reason, and you've been paying off your equity, the only way to recoup that is to sell your home. And we're not selling this house. I'm telling you right now, it ain't happening because we got our youngest in 6th grade. We got to see him through high school. Now we would if all hell in a handbasket occurred, but it ain't happening for a number of years. So let's just say I have a bad year. In 2018, I made 24,000 bucks. That's it. 2000. That was my first start of my business. So let's say I had a year like that. That's not enough to pay the mortgage. All right. And then still got braces, still got health insurance, still got all this. So where's the money come from? And we're not selling the house. That doesn't make sense to take a 5% on whatever the house is, $15,000, $20,000 commission to downsize so you can draw equity of your home. You still got to find a place to live. And so man, if you have secure income via a pension, via Social Security, via annuity, or you don't have that much expenses because you have, other than, your mortgage, you have no debt, which we don't now, again, thanks to you all. I would have to say you got to invest, but they're not necessarily mutually exclusive. So I put a certain amount of money. What I try to do is I say, okay, I'm going to put $1,000 a month into my M1 account. I'm going to put $800 a month on my mortgage. That's what I do. I think about this a lot. Like, man, I should take that $800 a month and put it on M1, and I think I should not do the M1 and put it on my mortgage and all that. But I'm comfortable with the way it is. My M1's building enough. It's not nearly where I'd like it for it to be. My cash account is not nearly for where I'd like it to be. I just got done paying a significant amount of taxes last year, which really hit me hard. And I knew that, and that's the thing. If you're self-employed and you make good money, you're paying 7.65 on both ends on the first 138,000 bucks. Then you're still paying, was it 1.45 on both ends for the rest of the money, plus your state of Georgia taxes, plus your federal taxes, so anyway, I think I would invest it just because I want the liquidity. But Josh, if you invest it, so let's just say, where do I do my calculator? Let's just say you invest it. All right. And let's just say you invest it, and we say now you got 35,000 bucks. You've been doing what I've been doing, put $1,000 a month in for 3 years. I'm not using any growth or anything like that. And you got let's say 20,000 bucks, and now the market is down. We'll say 25%. So now you're at 15,000 as opposed to 20. Well, that's still 15,000 of liquidity that you have access to. That you can use to pay your mortgage. And for me, that's my number one concern. How am I going to pay the mortgage? It's funny the difference my wife has and I in terms of the risk that she feels with the children and my risk that I feel with the finance. It's very, very different. My kids can walk to school for all I care. I mean, hell, I did it. She did it, but she gets nervous by that. But it's just interesting. I worry about the mortgage and she doesn't worry about the mortgage so much. It's just an interesting dynamic there. But if you had 20,000 bucks in your M1 account and the market falls, 25%, you still have 15,000. And for me, 3,000 bucks a month of property taxes, PITA, property, principal, interest, taxes, and insurance, a 3,000 bucks a month mortgage that's five mortgage payments right there, even though I just lost two because the market was down. So I would pay off the mortgage for sure. I mean, I would invest for sure if they're mutually exclusive as opposed to doing one or the other. Dow futures down another 600. All right, actually, all right, hold on. I want to show you guys something else. I was going to show you if I can find. Yeah, let's watch this. Bear with me just a second, my friends. We're going to go to. I want to show you guys something which is pretty flippin' sweet. Yep, the Dow futures. There you are. Let's go to VWELX. Oops. Hold on just a second. VW. God almighty, can't type for crap here today. Where the hell's W? WELX. All right, there we go. Hold on just a second. I want to show you the Wellington Fund. If you don't get a kick out of this, all right, so we're going to go to here. Nope, we're going to go to here. All right, we're going to go to share. We're going to go to share. All right, and we're going to go to here. We're going to hide that. I'm learning as I go with Zoom. Let's see, let's make sure you all can see this. Hold on, I'm looking at my other computer here. It's not showing up, or is it? All right, there. All right, sweet. It looks like we're okay, cool. So I want to show you the Wellington. Let's go, man. This is freaking nuts. All right, so let's go look at the Wellington. We're gonna go. So I'm on a Yahoo Finance, then I'm gonna go to historical data. Seems like it's a little bit behind. All right, so we're gonna go to. Hold on, just a second. I want to make sure it's. All right, so we're gonna go to historical data. Is it working or what? I can't tell, man. Hold on. Maybe it's not working. All right, let me try something else. Hold on just a second. Let me go back to this. Yeah, what? I don't know what's going on here, man. All right, so I'm trying to get the share. Oh, right here. Here we go. Okay, fine. Phew, I was on the wrong thing. My fault. There we go. Share. Okay, cool. Here we go. All right, so this is good, man. So hang in there. Watch this. I should be showing Wellington Fund here. And when I do, I'm just going to do it. I'm assuming you've seen this. All right. So we got February 28th, 2020. The close was 41.21. That's Wellington. All right. So let's go. We take my trusty thing here, 41.21. This is, that's not the right marker. There we go. Sweet. 41.21. All right. So that's what Wellington closed at on the last trading day of the month, 41.21. All right. We're not caring about adjusted close right now. We don't care about that. So let's go down to what it was, 44.57, 44.62. Look at that. 44.62. So 44.62 minus 41.21 is, that's $3.41. So the Wellington Fund was $3.41. Let me get my calculator because I don't know my phone. So that's $3.41 divided by 44.62. The Wellington Fund's all of 7.6% down. That's it. 7.6% down. Now, if you look at VTV, which is what I own, I don't know if that's the best. Let's look at VUG. All right, so VUG, which is the Vanguard Large Cap Growth Fund, the index. We're going to go to VUG. We're going to go to historical data. And this is, I tell you, man, this is the benefit of a fund like the Wellington. So we're at 175, it closed, 201.60 minus 175. All right, so that's 26 bucks. So 26 bucks divided by 201. That guy's down 13%. So twice what the Wellington was down. Isn't that interesting? The point about that, if we go back to Wellington, because the bonds in there. Now, look, I don't like bonds. I don't think you should own any. I don't own any bonds. I think you should, but not owning bonds doesn't mean you don't own CDs or some kind of cash account. It just doesn't. Now, I'm 100% stocks with a little bit of cash. I just am. That's where I am. But I mean, look at the difference. The Wellington Fund was down half of that of the Vanguard Growth ETF. Does that make sense? The Wellington Fund, in terms of performance, has it suffered relative to the Growth ETF? Let's take a gander, shall we? So if you look at performance, and the reason is because the bonds ahead, but you create your own bonds with the barbell. That's the whole point about the barbell. The barbell is you're creating your own Wellington Fund. You have, basically 70% roughly, or whatever it is that you have 70% stocks, 30% CDs. All right. You can have Ginnie Mae. It's a bond fund. I don't really care how you do it, but you have 70%, and we want 4 years, essentially 3 to 5 years of cash and CDs, Ginnie Mae, cash accounts, something like that. But you have 70% in stocks, and you got 30% over here, depending on what your cash needs are. If your cash needs are only $5,000 a year, then you put $20,000 in the CDs or the Ginnie Mae. If your cash needs are $6,000 a year, you put $30,000 or whatever, something like that. Does that make sense? So you got 70% over here, 30% over there. That's exactly what Wellington's about 65-35. And if you look at it in terms of the overall context of your overall portfolio, not just your stocks, but your portfolio. You start with $100,000, CDs and stocks, and now you're down to $93,000. You're down 7%. You start with $100,000, and now you're down to $85,000. You're down 15%. But to only focus on your stocks doesn't make sense. People do this all the time. They say, "Oh, my stocks are down 15%. I'm getting hammered." Okay, but if you focus on the barbell for retirees, then why would you only look at the down of the stocks? Don't do that. Look at the whole thing. This is what Right Capital is so great about. What do you have in your software, the Right Capital, that shows you your total asset allocation? That does not include cash necessarily. It will include cash within your investment accounts, but it'll show you your net worth. And you can look at your net worth. You can look at your accounts, your investment accounts, SANS, another French word, without stock, without cash. You can do whatever you want, but it shows you your total net worth. What is your total net worth? Liquid net worth and total net worth. What did it drop to over the last few days? And you say, "Oh, it's not that bad." So the people who are panicked about stocks, I see all these videos. I'm like, stop that, man. It's nuts. All right, so let's go down here. I want to show you 1, 3, and 5. Let's just write these down here. So Wellington over, let's see. Let's just go. 3 is 10.51. 5 is 8.94. And 10 is 10.12. Now, Wellington is a conservative, a dividend-paying fund. All right, just be advised, is most of the stocks in here are dividend payers. All right, so Wellington is on the. It's not even, I don't want to say safer, because the higher the dividend yield, the lower the PE ratio, the lower the P book, price of book. That means it's more of a riskier stock. People say otherwise. They're going to say dividend payers are less risky. That's not true. It might be true in dividend payers, but it's not true when it comes to value. There's a reason value stocks are valued, because they've been knocked down for some reason. They didn't meet their earnings numbers. Their CEO is, freaking caught donating to Bernie Sanders. We don't know what's going to be. But value stocks are not safer. Just because you have a higher dividend yield, just because you have a lower PE, does not mean they're a safer stock. If anything, it's more aggressive for sure. But anyway, so let's take a gander. So we got, what did we say, 3, 5, and 10. Now let's take a look at VUG. Let's go here, VUG. And the point about it, I'll share with you a point about this whole thing in just a second. We're going to go to performance, and we'll see VUG was down, actually not as bad as I would have thought, 2018, but in 3, 5, and 10, 19 for 3, 9, geez Louise, 19, 14, oh, look at this, and 15.5. All right, so let's stop sharing for just a second. All right, so here is Wellington. Well, I can't even read my own writing. It's 10.51. 10.51, 8.94, 10.12. That's 3, 5, and 10. All right, so here's Wellington. 3, 10.51. That's VUG, large cap growth, 19. 5, 8.94. That's large cap growth, 14. 10, 10.51. And that's, I can't read what that says. That's 15.5. All right, so large cap growth has dominated that of Wellington, which inherently makes sense. Dividend paying stocks have not done as great as growth stocks, and the fact that Wellington's got a third of his portfolio in bonds. The point about this, though, is that the barbell creates your own thing. And when you have the barbell approach, when the markets get hammered like this, you don't get hammered nearly as much. Now, you're not going to gain nearly as much on the upside, generally speaking, on any given day. But over the course of 5, 10, 15 years, this whole thing goes back to dividends. I tell you, man. In fact, I want to show you something else. I'm on a thing here. Bear with me just a second. I want to show you this article I was reading today. Hold on just a second. I'm going to find it. Hold on just a second. This is fantastic. This is from Lord Abbott. Oh, man, where'd I put it? No. Hold on just a second. Yeah, right here. Okay, so we're going to go to, I'm not going to be able to find it on this computer. I wonder if I found I'm not sure how to find it. All right, so I'm going to show you something. I'll do a video on this tomorrow. I'm not going to be able to find it on this computer. Anyway, just going back to the episodes I did this last couple of days about dividend payers. I'm telling you, man, the dividends on the Wellington, the dividends on the value stocks, the dividends are going to be your cat's meow when times like this happen, simply because the dividends, not only do they give you a buffer against a cushion, against a significant decline, as the dividends continue on and continue on and continue on, you're making more money from the dividends. Those companies are rewarding the investors with paying not frequent dividends, but higher and higher dividends, most likely. And then you're buying more shares as well. It's almost like, and this is one thing I think some people get wrong about whole life insurance. If it's a participating policy on whole life insurance, those dividends can really, for a long term, can really pay off big time. You don't want a universal life. You don't want a non-dividend paying whole life policy. But the issue is over the course of years, those dividends can really, really make a difference. And when it comes to stocks, unlike whole life insurance, not only stocks, the stock price going up over time, the dividends are dollar cost averaging. And I'm telling you, man, just the fact that we had 10.5% annual dividend growth over the last 10 years, 10.5% dividend growth over the last 10 years. It's nuts. All right, so let me stop that. Let me see what kind of questions we got here. Hold on just a second. Actually, who said that? Payout ratio. I want to point out something too. I didn't see where this is. My man Vinyl Earthlink had pointed out. Oh boy, here we come. Here comes the life of the party. Come on up, buddy. There we go. Oh yeah. Oh, why do you keep running away? People want to see you. Oh yeah. There he is. Yeah. 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 Clap, clap. Oops, oops, oops. There he is. The happiest dog in Georgia. At the Gwinnett Stripers game, there is Wet Nose Wednesday, which means you can take your dog to the baseball game. And we're going to take this little bundle of joy, aren't we? Pablo. Pablo. Yeah, I love this guy. All right. Let's see here. All right. So let's. Yeah. If you go back when I was 25, what's the most important you think changed for retirement? That's a good question, Kevin. If I could go back when I was 25, what's the most important thing I changed for retirement? Am I still sharing this? I'm not right. No, okay. I think I would, I wish I would have learned the 10-10-80 rule better, if that makes sense. I think that would have saved me a lot of consternation. 10-10-80 rule is 10% to the church, 10% to savings, and 80% to spend. If I would have learned that from the get-go, I think that would have saved a lot of, I'm not say heartbreak, but hold on. What are you? Okay. A lot of consternation. I've always worried about money, man. It's just, I've always have. I don't know if my wife was poor and she doesn't worry about it. She's not worried about it, but she doesn't worry about the same thing as me. But money's always been. There you go. There you go. Good boy. Money has always been a top of the mind for me, and I don't know why. I'm not greedy. Like I was like, money. I'm not like that. I'm not Scrooge McDuck, but I just think I wish I would have known better about the responsible spending, if that makes sense. It's easy to get caught up in. See, I've never really bought. I've never driven a real fancy car. I just don't care about that. My house is this is the nicest house by far we've ever lived in. But, we haven't. I just none of that really matters all that much to me. But I wish I would have just been a better steward of my money, my resources. I think that would have saved me a lot of consternation. With that said, in 2007, no matter we made all $32,000 that year with the family of six, and everyone's making fun of that George Bush tax cut, the rebate for like I think it's $150 per. I can't remember what it was, but we got like $600 I can't remember. We got like $600, and let me tell you, man, I need that money. Something wicked. We did. I remember sitting there thinking, coming home to the check come to the tax refund check come, and needing that and doing like the people do, which is they file their taxes right out of the gate because they're looking for that refund. You don't get a refund if you don't pay tax, but you know how it is. I mean, it's a welfare check. But by the way, that earned income tax credit, when they talk about poverty stats, that's not included in poverty stats. Just FYI, most transfer payments are not included in poverty stats. Thus, when people say 1 out of 4 children or 1 out of 5 kids are living in hunger, poverty, it's fake, man. When people are saying all these people don't have any freaking any income, it's fake because they're not including transfer, they're not including housing, they're not including medical, they're not including EITC. The vast majority of transfer payments, i.e. welfare, is not included in the poverty stats. All fake flipping news. Anyway, that's what I would have done differently. That's the thing, Kevin. When you get it, I presume you're 25 years old. When you wake up as a 49-year-old man, you say, man, I wish I would have done this differently. I wish I would have done that differently. That means you're probably not satisfied in your current lot in life. And I'm very satisfied. So anything I would have done differently would have sacrificed 90% of where I am today. I'm very, 90%, I'm happy, completely happy. 10% is like, oh man, I wouldn't take that risk for anything. I wouldn't have traded anything to get an extra 10% of where I am now, which could have sacrificed 90%. That's not a good risk reward. It's kind of like, who was I reading? They bet on, oh man, I forgot. I think they bet on the Pats to beat, who the Pats lose to the playoffs now? I forgot. The Titans, right? Or Houston. Who the Pats lose to? I forgot. But anyway, they bet like freaking 70,000 to win 10,000 on the Pats. That's just a stupid bet, man. That's just dumb. So I would not bet 90% to gain 10. That doesn't make any sense. So I don't have that much regrets. But I do know I don't want to be poor again. And that way I say I need to have more savings. That's all there is to it. And I still think that. All right. So Clint, I haven't seen you around in a while. Clint, good to see you, brother. If you were investing in a taxable account and you wanted to use it this is my man Roberto from Long Island, and you want to supplement your income with passive income, what types of fund would you be looking at? I want to supplement my income with passive income. I'm just, things like the Wellington Fund or Wellesley Income Fund. I mean, that's what, it depends on your tax bracket, Roberto, but generally speaking, I would do, that's what I do. If I want some other source of income, I'm looking at dividends. Absolutely. Dividends, qualified dividend income. Wellington is going to have some bonds in there. So a bunch of that is going to be ordinary income, which is kind of not what you want, but it will provide you income. And you said supplement your income. It's tough to beat that. I just think if you look at dividends that are growing each and every year, 10 years. So the article I was going to read to you was from Ward Abbott, and they just showed you, hold on a sec, right there. They showed you an income off of, so going back to 1976, I'll do a video on this tomorrow. They had a initial investment in the S&P 500 was $10,000. Initial investment in the Barclays Aggregate Bond Index was $10,000. First year income on the S&P 500 was 461. First year income on the Barclays Aggregate was 745. So basically, you're already making $300 more in income on the Barclays Bond Index than you were on the S&P 500. Final year income, and this is in 2013. Final year income on the S&P 500 was $4,058, man. Final year income on the Barclays aggregate, 272. Ending portfolio value, just price return only, not even including dividends. You're living off your dividends. The S&P 500, $204,960. The Barclays index, the Barclays aggregate bond, 10,952, which goes to show you, that's like I said all the time, you know exactly what your bond is going to give you. So while the bond made $745 of income the first year, which is $300 over that of the S&P 500, from then on, the S&P 500 was paying you, I mean, we're talking, you know, 272 on the Barclays index, a bond index versus 4,000. Crazy. I love this too. They have a yield on cost. And what I did a video one time that really ticked a lot of people off. I said, how you can get a 50% dividend yield. I forgot what it was. And I'll show you right here. So basically that $500 of income you made on the S&P 500 had given you basically 5% dividend yield. So you basically invest $10,000 in the S&P 500 back then. It gives you $461. Your dividend yield is 4.61%. Does that make sense? Now your yield on the Barclays aggregate bond index was 7.42 because you made $745 on a $10,000 investment. So I want to write this down. I think it's important. So you got $10,000, stocks, bonds. Stocks gives you $461, which is a 4.61% yield. Bonds give you $745, which is 7.45%. Hopefully this makes sense. So each one you're investing 10,000. Here's your stocks. You're getting $461. $461 into that is 4.61. You're getting $745. $745 into that is 7.45% yield. You fast forward until 2013. All right. So you fast forward into 2013. You still invested $10,000 into both, but your $10,000 invested in your stocks is now paying you $4,058. Your $10,000 invested in your bonds is paying you $272. So 440.58%. Oops, 2.72%. I mean, look at this. So you invested $10,000. You're getting $4,000 a year in income. Your dividend yield, your literally yield, is 40%. Now, people call that the yield on cost. It's all semantics, brothers and sisters. It doesn't matter. That is still a fact. You are getting $4,000 on a $10,000 investment. That is a dividend yield. Yield on cost, I don't care what you call it. That is a fact. Your bond, on the other hand, is only paying you, what, $200 or something? Yeah, $272 is 2.72%. So the issue that comes to mind is that with the dividends, they're growing. And even if you don't reinvest them as a growing dividend, it's just, never mind the taxes on QDI, qualified dividend income versus ordinary income. By the way, government bonds, this is odd to me. A lot of people don't realize that government bonds are fully taxed. Federal income, absolutely. So your treasury bonds, Ginnie Mae's, taxed as ordinary income. They're not tax-free. I had a couple of people say, no, they're not. They're not. They might be state tax-free depending on what your state does. Like Tennessee, well, state tax-free anyway. So don't get caught up in the government bonds are tax-free. That's simply not the case. Anyway, so you look at a fund like the Vanguard Dividend Growth Fund. I own it. You should own it. I mean, I don't know what your circumstances are. I don't know if you got a pot to pee in. I don't know. But how do you just look at dividends and say it's a non-efficient use of capital when it just adds and adds and adds? Now, look, I mean, if you look historically, you know, the dividends return about 50%, roughly about 40% to 50%. If they're reinvested over the overall returns of the markets. And that's real flipping money. 40 to 50% of the market returns is attributed to reinvestment of dividends. If you take that away, it's all on appreciation. Why do that to yourself? So anyway, going back to the issues, on any given year, bonds will give you more than dividends, for sure, generally speaking. I guess not now, because I mean, the 10-year treasury right now is paying. So if you look at the 10-year treasury, oh, here it comes. Come on back, monster. 1.127. So I'm going to hold this up for 3 seconds. That's a 10-year treasury. 1.127 is what the 10-year treasury is paying. All right. That means you invest $10,000 in the 10-year treasury, you're getting 100, yeah, right, $100, $111. That's it. $112, $112. The VUG, which is the Vanguard Growth Index, is paying 0.99. So right out the gate, VUG is paying better after tax than the 10-year treasury. Right out the gate. I mean, it's a hell of a lot more risky on any given year. I get that. But what's the likelihood the 300 odd stocks in the Vanguard UG are going to all go bankrupt? I don't think so. I mean, it could, but I'm just saying it's not likely. I just haven't looked at the 30-year treasury. Hold on just a second. 30-year treasury is 1.67. And so, you know, people always gripe about the declining value of dividends. Well, how about the declining value of bonds? Especially if you bought bonds in which to live on it. I'll tell you, go back to the, I'm going to share this with you. Hold on just a second. I'm excited now. I'm comfortable with the sharing thing. So we're going to go here, share, and I'm going to go to American Funds ICA guide. Let's see if I can't. This is water, by the way. Did I tell you I got my haircut? Oh, before I forget. Next week, my friends. Let me stop sharing real quick. We're going to open this guy up. All right, so next week, big excitement. How does I do this? That's pretty good. Big excitement. Be here or be flipping square. Got primo guest coming on, Andrew Biggs from the American Enterprise Institute, the number 2 guy. I think I heard him say that, or maybe I'm just making stuff up to make myself look good. The number 2 guy from the SSA, Social Security Administration, for under the George W. Bush administration, will be here live and in person. Ask questions. If you are on my Subscribe Star thing where you pay $10 a month, fire your questions at me. You are going to get first dibs on questions. I'm telling you right now. Andrew Biggs from American Enterprise Institute, AEI, who writes all kinds of articles for Forbes. I'm looking at one right here, which is he had written through the George Mason University Mercatus Institute, mercatus.org. Is there a retirement crisis? The dude's just a monster when it comes to this stuff. He's got his PhD from, I think it was the London School of Economics. I interviewed him not too long ago. I asked him how he came out of LSE and not become some Marxist. And it takes guts to come out of London School of Economics and maintain a semblance of free market libertarianism, but he did. And so the funny thing is, when you got a guy like that, why I love him even more is because he knows the other side of the arguments. In fact, he, I mean, what I love about a guy, well, what I love about counterculture, you know what I'm saying? Not the counterculture, because, you know, the left runs everything now. Let's just admit that. We've lost the fight. The right has lost the fight. The left runs everything. But thankfully, the youngins coming up, I have a sneaky suspicion they're going to be counterculture to the left, because the left is authoritarian more so than the right ever even imagined. And so when you come up and everyone's preaching at you from one point of view, those are those who've got the guts. So research say, there's got to be a different side. And when they stay true to the cause, that means they know the other side's argument is better than the other side does. Like like my man Six Hexhammer. I mean, he knows, I guarantee he knows more than most of us about the Bible. Guarantee. Guarantee he can argue against you about atheism versus your theism. I guarantee. And if you're a believer, as I am, well, you doggone better get in the Bible, which is what I've been doing now. I've been every day reading 3 or 4 chapters a day. I didn't do a video today or yesterday. I just got caught up, but I'm going back to Genesis with Lot and whatnot. I'll revisit that again on my Jesus channel, which is right here. Everything I do is my Jesus channel. But anyway, what happens is when you know the other side, and then you're able to stay true to your free market beliefs, or even, in this case, when you're born and raised a Catholic or a Christian, and then you're like, that makes sense, that makes sense. And then you learn the other side, you're like, man, your arguments are somewhat weak. You got to be able to defend your arguments. The only way you do that is by knowing what the other side's polemics are. Anyway, so the point is, he's going to be on, and I cannot wait because this can be great. So my Subscribe Star thing, those who support me, if you like my work, donate to my Subscribe Star channel. If you want to support my work, I hear that all the time. And I chuckle, but I support Dave Cullen, Cullen, my Irish guy. I support Styx Hexhammer. I support Tim Pool, Paul Joseph Watson. I support one other guy too, or one other lady. I forgot who it was off the top of my head. Some lady in Australia, I think, or maybe the Rebel News up in Canada. I think anyway, either way. I just like people who got the guts to say what the mainstream media won't say. For instance, Trump never once said coronavirus is a hoax. He never said that. Mainstream media is fake news. Trump never said that. Fake news. And it's nuts. And yet that is what it comes to, they fact check. They got tons of fact checkers to make sure they don't say stuff about that's completely lie. Anyway, so my man Andrew Biggs comes along. He knows more about Social Security than you and I and Pablo combined. And trust me, Pablo knows more about Social Security than I do. So if he knows more than you and I and Pablo combined, this guy knows a lot. Anyway, if you're on my $10 month subscribe star thing and you have a question specific, email me directly. Absolutely. Just say you're on the subscribe star thing and I'll double check to make sure you are. And then if you are, I'm going to ask. I'm going to say, Andrew, I got a list of questions. I'm going to ask you one by one by one. Absolutely. Ask him. And if you need a little bit of a kick in the pants because you're worried about coronavirus, you're worried about what the AFC winning the Super Bowl, you're worried about the Bernie, you're worried about Trump. What else can we be worried about? Social Security going bankrupt. What else are we worried about? We got lots to worry about. We're worried about an EMP. I don't know what else to be worried about. The repo market. Again, that's not repossessing vehicles. Again, no one cared about the repo market until October last year. If you're worried about this stuff, we're going to bring Andrew on and he'll give you a gauge. The interesting thing about Andrew is he told me my plan for fixing Social Security was Bernie Sanders like. Because I think what you should do to get the Warren Buffetts of the world to whine that they're paying less income tax as a percentage than their secretary is you just say, we're going to throw 7.65 for Medicare or I guess we already got it. Well, do we have it on that? I don't know. But we're going to throw FICA on your qualified dividends, long-term capital gains. Simple, done and done. You're still taxed on QDI and long-term capital gain will still be significantly lower than OI. And one of you guys who I'm very, very fond of, by the way, who was arguing vociferously that'll just go to the general fund other than, the trust fund, the lockbox. I said, I don't know why we can't just say this is a FICA tax. I don't get it. We just say this is a FICA tax. It goes up to big Social Security, Medicare, and Medicaid, and we're solving. I don't know why we can't do that. I mean, that's what FICA tax does. So we say we're going to put FICA on QDI and we're going to put FICA on LTCG. And if you have more than $1 million of income on QDI and or LTCG, 7.65 will go towards that. Done and done. And yet your QDI and LTCG is still less tax than OI. It's a friggin' smoking deal. I don't know why this isn't get more leeway here, but anyway, it's funny because Andrew, he wasn't making fun. He goes, yeah, that's kind of what Bernie's proposing. Elizabeth Warren, that's what he says. I just kind of chuckled at that. And of course, I still think a wealth tax. People are like, oh, you're what they call me, statist. I just chuckled at that. The reason I like a wealth tax is simple. Because we see what Bezos is doing, which he's giving all kinds of money to foreign rabble rousers on activists on green energy. And they're making buck off us subsidizing these guys. I say, screw all that. Let's be done with all this. Let's not subsidize the churches. Let's not subsidize the schools. Let's not subsidize the green activists. Let's not subsidize the pro-life activists. Let's stop subsidizing everybody and just say, if you want to donate, more power to you, but you're not getting tax deduction. That's nuts. All right, let's go into this here right here with the American Funds ICA guide. This is freaking awesome. And we still got people watching. Good. Haven't lost y'all yet. All right. I've done 2 videos on this. I've been reading the ICA guide since 2003. And I just want to show you something here. All right. It's key to stay ahead of inflation with rising costs of living. In 1934, when the Investment Company of America was started, roughly the same time as the Wellington Fund, the postage stamp was at 3 cents. 1980 was at 15. In 2018 is at 55 cents. Loaf of bread, you can see how inflation has gone up by 1,743%. Single family home in 1934 is at 5,900. 1980 was at 6,200, and now the median single family homes 261,000, which is absolutely true. And then you can see the automobile. So all these things have gone up by the thousands of percentages. All right. Stocks have had the highest returns over the past 50 years. We know all this stuff. All right. So let's keep going right here. All right. So we got Margaret and Harry Boone. All right. They invested. Let's read this. We got the Boones and the Clausens. So let's see if they changed the video. Oh, man. Oh, that's funny. They changed the pictures of the Boones and the Clausens. That's I've been around this business a long time, man. That makes me feel old. It's kind of like when like a musician, you've been following since you're young, dies from old age. Like, man, I'm getting old. I'm going to read this to you. 20 years ago, at the end of 1998, the Boones and the Clausens retired. Each couple had $200,000 to invest. The Boones put their money in a 20-year government bond that paid a guaranteed 5.39% a year. They were satisfied with their annual income of $10,780. 20 years ago, you may have been able to get by on that, but it takes $16,524 today to buy what $10,780 bought in 1999. So it takes $6,000 more to have the same purchasing power 20 years later. Even worse, when the Boones bond matured at the end of 2018, they went to buy another and found the rate on the 20-year Treasury was all 2.87% at that time, which provided them only $5,740 a year. Of course, the Boones are guaranteed the original $200,000 nest egg, but that won't buy as much as it used to either. The Boones' safe investment, it seems, wasn't so safe after all. So here they got $10,780 each and every year because they put $200,000 into a 20-year Treasury bond that was paying 5.39%. The original investment, $200,000. They got $215,000 out now, and it's worth $200,000 at maturity. Now they got to turn around though, invest in half. They're getting half what they used to, not $10,780, but $5,740. Right now it's even significantly lower. All right, but let's watch the Clausens. All right, so here's Vivian and Joe, and they're on the bikes and they're smiling. So they're obviously enjoying life because they invested right. And here's before they had the Boones were miserable. He had an old guy like, it's just kind of funny. Don't make him as miserable here, but anyway, just kind of funny. All right, so here the Clausens invested their $200,000 in the Investment Company of America. And I'm like, you can invest in this fund. I don't care, but I'm just using this because this is what the ICA guide is based on. And they decided to take monthly withdrawals at an annual rate of 5% of their account value at the end of each of the previous year. That meant they took $10,000 in 1999, representing 5% of their original investment. They took 5% of their account balance at the end of 1999, and so on. All right, so they took monthly withdrawals at an annual rate of 5% of their account value. So it's 5% of their account value. Remember, I say 5%. 5% of the account value, 5% of the account value, not 4% rule, which is going up with the rate of inflation, just 5% of what the account value is. That makes sense? All right. Because the value of the investment has gone up and down from year to year, their income has varied. They started out living on less than the Boones. They had $10,000 in 1999, where the Boones had about $10,780. They started out living less. More importantly, the original investment, but the Clausens' income generally kept pace with the Boones over time. More importantly, their original investment increased substantially over the long term. They enjoyed greater rewards because by investing in a portfolio of stocks, they chose to accept greater volatility, recognizing they could lose money. Despite recent volatility, the last 20 years of the ICA were generally good. In 66 of the 20-year calendar periods in the ICA's lifetime, the Clausens would have had more in their account than the Boones after 2 decades of withdrawals. So let's see what they got. Does it say how much they took? Right here. So they put in $200,000. They were able to take $200,000 out, and they had $250,000 when all said and done. And that's after 2018. You throw in 2019, it's going to look it'll be 30% higher. So at the end of the day, they're making more income here, $14,000 of income in 2018 because the dividends are increasing, where these guys are making $5,000 because the yields have gone down. The interest rates have gone down significantly. On top of that, they only have $200,000 left, and these guys have $250,000. I just find that to be nuts. So let me just keep going back to, I want to show you the value of dividends. I don't know why I'm off the dividend kick here, but I am. You can look, I'll put a link to show us for all this. I want to show you if I can find it. Oh, right here. Growth of a typical $100,000, $10,000 investment through 1934 through 2018. All right. So we go down, we're going to go down. We're going to see the Statue of Liberty. Hold on just a second. Hold on just a second. Hold on just a second. Right here. ICA, $10,000 invested in 1934 with dividends reinvested, $138,000. An average return of 11.9. 12%. Where do we see this from? Oh, Dave Ramsey. I don't know what his guys do. I almost guarantee you it's going to be the Investment Company of America from American Funds. Almost guaranteed, because he keeps talking 12%, and that's where he's getting it from for sure. But watch this. ICA with dividends excluded, not reinvesting your dividends, just taking the cash, 11 million bucks. The reinvesting of dividends is insane. Now this goes back many years, I get it. $138,000, $138 million versus 11 million, just because of dividends reinvested. And the funny thing is, reinvesting the dividends would have given you 11.9. Not reinvesting the dividends gave you 8.7. I mean, that's not, what's that, 3%, a 3% difference. But those 3% represented 120 million. It's nuts. It's not nuts. It's crazy. Anyway, so I love pointing that out because I think it's pretty important to see. I want to see, did they get rid of the, oh, right here. Oops, right here. All right. Hold on. This chart is based on a logarithmic scale, so it uses smaller and smaller increments for larger numbers. If the scale arithmetic, with 1 inch representing every 10,000, the dark blue area indicating results of dividends have been invested would be 99 feet tall, which is about as tall as most 10-story buildings. The lighter blue section, which shows how the investment would have done if dividends had been reinvested, would be 1,151 feet tall, nearly 8 times the height of the Statue of Liberty. So reinvesting your dividends, not reinvesting your dividends. So here's the Statue of Liberty, 151 feet. If you didn't reinvest your dividends, you had, 50% lower than the Statue of Liberty in terms of total feet. If you reinvested your dividends, that's crazy, man. It's nuts. All right, here's Louis the Loser. I just want to go on this a little bit. Timing is what matter. What matters, they got Louis the Loser. He's been on here forever. It's just, I'm not gonna read that to you because it's nuts. Anyway, then all right, so I'm done with that. It's lots of good stuff in there. I'll put that in the show notes for sure. Huge fan of that. And why do I go on that tangent, my friends? Because my man Roberto said, what would I do for passive income? I think you got to buy dividend stocks without question. Dividend ETFs. I would not buy individual stocks, Roberto. If you actually download the ICA guide, which I'll put a link in, you'll show where it shows you that if you would have bought like 5 stocks back in, I can't remember what it was, but it just shows you you'll be making a great mistake by buying individual stocks as opposed to mutual funds or an ETF, because you just don't know what stocks are going to outperform. You just don't. And the ICA guide will show you that you could have put, I think it was like $10,000 in all these stocks, or if you just would have put the $50,000 in the ICA, I can't remember what it was. It's insane. It's insane. And the ICA, Investment Company of America, gets all 3 stars from Morningstar. It's not very sexy. It's just not. It doesn't outperform all the time. It just chugs along. It's kind of like Berkshire Hathaway, man. Over time, it's done incredibly well. Smoked the S&P 500. A huge proportion of time, it doesn't, though. And it's 3-star rating. No one cares about it. Boring. I'm not saying you should buy it, but that's kind of the way I look at like the Vanguard, like a dividend growth fund, for instance, the Vanguard or something like that, where you get growing dividends. I just believe in that for sure. All right. I guess I don't watch golf on TV. If they had it, I don't know anything about golf. Sorry, man. Vanguard throwing the towels on its manager payout fund. All right, so Al's, I guess, not a big fan of his managed payout fund. Yeah, I'm not a big fan of it. 16th Street and Greenway, familiar with that. Yeah, XFL's. In fact, let's just see here. Who ended up winning that game? Let me guess. Freaking. If I like the team, you know they're going to lose, and so let's just take a look to the Dallas. I don't. I. Yep, Houston beat Dallas. Ooh, Tampa Bay is beating the DC right now, 16-0, and they got the ball. Ooh. All right. Yes, Evening Developer said this week demonstrated the importance of the barbell defense for sequence of return risk. Man, right on, man. I could not agree more. It's the whole point. Hey, Alberto and his better half. And if you had if you're taking money out, you don't want to take it from a portfolio that's down, 14, 15, never mind 30%. You want to take it out from cash. Florida. Hey, James, what's going on? Jeff in the house. All right. On his beachfront property. She's the queen of my double wide trailer with the polyester curtain and the redwood deck. Who is that? I sang this to you about 2 months ago, and I think I quizzed you back then. I'm not sure if anyone would remember that. All right. So Mushke says, our friend in Washington, she is 59 and a half and looking to quit her high paying but crappy old job. At 65, she'll get $3,000 a month pension, and at 67, she'll get Social Security income of $3,000 a month. I'll have no debt except a home, which I'll sell. I just talked to a lady the other day. I'm going to do a video on her. We're going to call her, we'll call her Anne Marie. All right. California Anne Marie, we'll call her. Anyway, so California Anne Marie is going to sell her house in California for pretty good money, all right? Because the houses in California are expensive, believe it or not. Now, off the top of my head, I can't remember exactly what she has, but we went over what she should do in terms of living before taking Social Security, doing Roth conversions, things of that nature. I'm going to do a video along those lines. And she's single. Get lots of people say, you don't do enough videos on singles. I got single Susie. I got Scott single. I got all kinds of single people, but I'm not, maybe I'm not titling correctly. I don't know. But anyway, so we're going to do on Miss Anne Marie, similar to the lines of old Mushke here, Mushke Potamus. Jude's is in the house. All right. Alabama, Rebecca Thompson. Sticking. All right, right on. Yeah, I'll be able to pay cash for my retirement home. I told you all that I had crabs the other day. Oh, I'm telling you, that right there. I love either the mountains or the water, but I got to live near crabs. I can eat crabs all day long until someone threw some crab, legs, the crab thing down the freaking garbage disposal, and it got stuck. So I was messing around with that today. You need more than just, anyway, it's not hard to fix, but you got to have the right tools, man, for everything. Got to have the right tools. Thankfully, I had the right tool because I had to replace a stupid garbage disposal a couple months ago, but I couldn't find it to save my life. And it's not just an Allen wrench. I tried all my Allen wrenches, none would fit. There's one tool that got to be the right one. I was like, man, anyway. But once you get the right tool, it's easy. But just have the right tools. So Kenny says, I know you say only to take money out of stock bucket when the market makes money. But what if you're taking 5% out, but the market only gives you 2 or 3%? So let's go over this. I got my favorite new tool. All right, so I'm going to share with you this right here, which I've been working on. All right, I'm going to share with you this right here. All right, my friends. Let's see, hopefully y'all can see this. Hold on just a second. I'll do another video on this tomorrow, but just for special guests. I'm hoping that you guys can see this. Hold on. Hold on. Stay with me. Stay there. Stay with me. Stay with me. Yes. All right, cool. All right. So I'm going to the S&P 5. I'm not going to go too deep in this because I'm still working on it, but I'm going to the S&P 500, going back to 1871. All right. So what we're doing, if you look at we're taking $100,000. Actually, I want to go over here because I got the 5,000. So basically what I'm doing here, I'm going let's go over here. I'm going back to the S&P 500 to 1871. We got $100,000. All right. We're taking 5% a year off, and we're adjusting with inflation. So in this case, we are adjusting with inflation, not just a straight 5% like we just did a few minutes ago using the American funds thing. All right, and I'll show you what I started in 1935. But anyway, it doesn't matter. I did this all morning long. So in 1935, we're up. Oops. So what you see is we're going to do like this. You ready? So that's the premise. We're taking $100,000. We're taking 5% a year off adjusted with inflation. Here's our inflation numbers right here. Here's our returns. All right. So the first year we have 100,000 times 1.54%. So we get that right there. All right. Then we got to take this amount right here off, all right, which is $5,112. So $100,000 made 54%, left us with 155,000 roughly. $5,000 adjusted with the 2.24% inflation puts us at 5112. Take 154,930 minus, so we got N2, which is this right here, minus that, and that gives us this. With me so far? Start with $100,000. $100,000 grew or went down by this amount here. This is N1 times M2 right there. So N1 times N2 gives us that. We take $5,000, we times it by this amount here. That gives us this as R2. All right. We take, growly. We take our N, Pablo, we take our N2. It's okay. It's okay. Oh, there we go, big man. We take our, Pablo doesn't like spreadsheets. It's okay. It's okay. We take our N2, which is this right here, subtract by R2, and it gives us our value after distribution of 149. Now we go back to here. So here we're going from, here we are going from O2, which is this right here, timesing O2 by this by M3, all right? And that gives us that number right here. Our 5,112 grew by 1.46%, so we need 5,187 this time. And that means we're taking this right here, which is 1998 minus 5,187 gives us 193. All right, so we're doing that, and we're doing it in 30-year increments every single time. That's a 5% distribution adjusted with inflation, 5% adjusted with inflation. There is 93 instances going back from 1900. I didn't go back all the way to 1871 because in 1871 it all succeeded. For 30-year time frames, there's 93. I think it's 93, 98, 93. I think I got 93 on the brain, but it's 93 instances. I ran these numbers going back to 1900. Again, if you went all the way back to 1871, you did not run out of money one time. Or that from 1871 to 1900. I hope that makes sense. But I didn't want to go back to 1871. I just want to go to 1900 just because it's easier. But this even makes myself look worse. Of the 93 instances, I think 13%, I want to say it's 11, I think. Again, off the top of my head, I can't remember specifically. I was going to do a video on this tomorrow, but I will. You ran out of money for 30 years. So taking 5% a year out, adjusted with inflation, 13% of the time, over 30 years, did you run out of the money? If we take 100 minus 13, that means 87% of the time you did not run out of money. Now, if we take away this year's right here from basically 1960s, right here, right about here, going forward, I think it's 1960, yeah, right, from the 60s into the 70s, with high inflation and low returns for the most part, no horrible returns, but low returns, but certainly high inflation. That's when the numbers worked against you. So if you take away those years, it was even better. If you add the 1870s to 1880s, 1890s, it's even better. So if you want to add the whole time, this is just the S&P 500 going back to 1871, 30-year increments, taking 5% a year off, adjusted with inflation. I mean, you're talking probably 6 to 7% of the time did you run out of money over 30 years, my friends. And basically, other than the 1970s freaking craziness, it never really happened. I think twice that included the Great Depression era did it happen. It's not a huge risk, and that's at 5%. It's not. And this is where I started looking at 6%. I said, it came in real good. And I said, I must be doing something wrong. I saw something wrong with my spreadsheet numbers. But anyway, if we go back to 1871, you can see the inflation is negative. negative, 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 and negative. So the reason I did not use going back then is because we're not likely to have disinflation or I hate to say, or deflation like that over the course of any significant amount of time. So that's why I didn't use the 1870s. Not likely to have low and again deflation for any significant amount of time. The issue here is you can take 5% a year off your portfolio. If you want to do 5% a year off adjusted with inflation, remember there's historically there has been a chance you could run out of money. That's over 30 years. What's the likelihood you're going to live 30 years? Not very high. If you retire at 60 and live to 90, there's not a high probability of that happening. It's just not. That doesn't mean you won't. Doesn't mean there aren't people who do. It just means there's not a high probability you're going to live for 30 years. There's not a high probability you're going to run out of money. You times two not high probability things, and you get not high probability events square, which means that even less highly not probable, if that makes sense. I think people get way too caught up in this. And the issue is inflation is the bugaboo, man. No other way around that. I mean, horrible investment returns are bad for sure. We can deal with low returns. We can deal with low returns. We can deal with a couple negative returns. We can. It's inflation that kills you, man. And the inflation of Nixon, the horrible presidency that was Nixon, was just bad. Look, man, everyone says, the left says Obama should get the credit for Trump. I don't know if I agree with that or not, but Reagan should get some credit from Carter. I'm telling you right now, if you would have asked me if I liked that anti-Semitic Jimmy Carter, I would have said no. But the facts were he did deregulate. That is a fact. Him and Ted Kennedy, they deregulated, which laid the foundation for some of Reagan's stuff. That's a fact. I don't think Carter would have done. I'm glad Reagan won without question. Reagan saved America. The big three: Reagan, Maggie Thatcher, and Pope John Paul. They saved the world from the communist red scourge. But at the end of the day, Carter should get some credit. So for those of us on the right who look at Carter as the antithesis of a good president and Nixon as a conservative, you're wrong. You're wrong. Nixon was bad. Horrible president. Horrible president. Carter was better without question. And Carter led the way to Reagan. And if you're a patriot, you should be happy. So anyway, this year, going back to my man Kenny, if you're taking 5% a year off, even if the portfolio is only giving you 2 or 3, who cares? I mean, I don't. Now, look, man, at the end of the day, if it starts getting too tight for you and you're getting a little bit dicey, then tighten your belt, man. Nothing wrong with that. You don't have to. There's no rule that's set in stone here. So let me just go back. My man Dick Longmire posts this a lot, and about the 4% rule. He goes, and now it's 3% rule, and he's right. Wade Pfau, Kitces, they say it's a 3% rule now. It's 3.2 to be precise. But the reason they say that is because the bond yields are low. But that it allows the premise to begin with, and the premise is the 4% rule had any legitimacy as it was. I don't understand. I don't understand the legitimacy of the 4% rule, and that doesn't mean I'm challenging Bill Bengen in the Trinity study. It's not. I'm just saying. Wait a second. Who out there says no time ever do I want to have any scenario where I've ever ran out of money, ever? I mean, it's just nuts. I don't get it. For over 33 years? I mean, why would you live like that? Say, I just want to make sure that if I run this for 33 years, not one time did I ever run out of money. Who lives? That's just dumb. And even secondly about that, the reason it's even dumber is that assumes your spending goes up each year with inflation. And there's just no evidence of that stuff. So why get all caught up in the 4% rule? It's not gravity. This is what drives you crazy about in the investment world. They're so hard to try to say, we're like a science. We're evidence-based. We're science. We have scientists. We got Ken, what's his name? Freaking Eugene Family and Ken French on our side. I can't remember. We got the 3 factors. Well, now they no longer do 3 factors because those 3 factors have somewhat been, I don't want to say suspects. I believe in them. Low PE ratios, low price to book ratios, high dividend yields. That's my 3 factors. I completely agree with that. I bought that hook, line, and sinker in 1994. I drank that Kool-Aid a long time ago, but it's not scientific. It's not science. Nuts. Gravity is science. Nuts. CO2 as a nutrient for green things is science. That's why I don't get the hatred and animosity towards CO2. It's science, man. It's science. So, vegetables need CO2. That's why you sing to your plants, by the way. You don't sing to your plants because the plants like to hear your crappy old voice. You sing to your plants because you're breathing CO2, and plants like CO2 as fertilizer. All right, so let's keep going down. I'll do a video on this tomorrow. So basically what I'm going to do, I keep saying I'm going to do a video tomorrow. When I say a video tomorrow, that means over the next week. What happens on what I was doing is I want to do, so I initially start off, 20 years with 6%. And I did freaking, I think I had 144 instances where I was just at the end of the day, I was pounding my head and saying, this is getting boring. So let's do 30-year instances. And when I found 5% and of 30-year instances, and only going back to 1900, not even including the 1870s, 1880s, 1890s, we had a roughly 85% success rate at 5%. I said, that's pretty comforting. If we do 6% in 20 years, what would that look like? And I might go back and do that again. I don't know. 6% with what did I do? I think it was about 55% of the time you're fine. Don't quote me on this. I think it was 55% of the time you're fine and 45% of the time you ran out of money, or maybe 60-40. I can't remember. It's still the majority of the time you had money if you did 6% and adjusted with inflation, not even including the 1800s. So why just limit yourself? That's what I don't get, man. So anyway, all right, enough of that. All right. I do plan to work. Okay. Hey, all right. What do you think about the Fed lowering rates? Oh God, are we going back to that again? Why in heaven's name would the Fed lower rates? That makes no sense. I know the Fed funds rate, just, Pablo, what do you think about the Fed's lowering rates? Do you want the Fed, Pablo, bark if you want the Feds to lower rates. Yes, Jerome Powell, listen to Pablo. He does not want the Feds to lower rates. I think it's nuts, Jill. Absolutely no reason, no way, no reason should the Feds lower rates. It's nuts. Hey, my man Alberto's heading to Puerto Rico. Right on, man. T-Mac. He'd been up in Carabasset Valley, Maine at Sugarloaf. Those folks are a hardy breed up there. Talk about a cold, windy place. Yes, sir. Pablo would not like this at all. Braddock Road Del Rey in the house. Oh, man. Oh, man. Ooh, they used to have the Del Rey Cafe down there. Oh, that was nice. And then there's this, oh, man. Where was that? There was this Korean barbecue place down the street. And I knew the girl I was friends with a girl whose parents owned that. Oh, that place is freaking awesome. And then there's some crappy El Salvadorian place down the street too. And I took my wife there one time to eat, and they left. There's hair in the food. I said, "Oh, I almost felt like puking." Look, I was in the infantry. We used to have to burn our own crap in Honduras. Even that didn't make me disgusted. But seeing this hair in there and just, oh, it's nasty. I said, "Ooh." All right. Let's see. Paying off mortgage. What's up? Growls. All right. Let's see. Hey, get a HELOC as a protective measure. That way you can access it if you lost a job. Yeah, that's actually a good point. So Mary Beth says to the question that came out a long time ago, pay off or invest. She goes, at least get a HELOC, a home equity line of credit. I agree with that for emergency measures. My concern would be if I know me, that sucker would be maxed out on things I don't need, I don't want. So now I'm right back to more debt because I use the HELOC to put, to finish out the, to put drywall up in the basement and to buy me better markers. That's my concern about the HELOC. It's just money that's burning a hole through your pants and in your pockets. And they can cancel the HELOC anytime. I tell you, I cannot agree with that more. That's 100%. Oh man, hold on a sec. All right, see. My only debt is a 0% car loan with 20K left. I hate debt so much I have to stop myself from paying it off. I still pay that off. Downsizing when retirement comes. That's what, as I said a million times, that's what I'm going to do. Sell this big old house. The better half and I will move to a 3-bed, 2-bathroom house. I used to think I wanted big acreage so I can, to raise some crops, get an apple orchard. I don't think I want that anymore. I think, really what happened was when my rotator cuff got tore, I realized, I don't think I want to be out, freaking digging ditches. I don't know. We'll see what comes this spring. I didn't put any trees in last fall. You always want to put your trees in the fall if you can. I didn't put any this fall. We'll see if I get back into it when spring's here. Now the spring's here. You might say I got a little color on my face. You're all white, Josh. You got a little bit of tan. Being at the baseball game today. But we shall see. I don't know if as I get older, get lazier. I don't know. I starting to lose my desire to get out and dig. I think I've done enough digging in my life. We shall see. But I always thought I'd want this big, sitting on an apple orchard or something like that and just, eat fresh apples. I don't think so. I think I want maintenance free. I think that's what I want. I don't know. We'll see how things shake out. All right. Al's plan, invest to get 401k match. Yep. And start emergency fund with Dave Ramsey baby step 1,000 at 20, 40, 60, 80 a paycheck. Nothing wrong with that. All right. Al says show Wellesley 2. Pulverizer says he doesn't care if he gets laid off anymore. Got it covered. That's FU money, man. I love it. I love it. FU money. I had that enough that I knew when I started this job that I would be fine for 3 years, even though I burned through all my money. I said I'll be fine for 3 years, I think is what it was. And that felt good, but I wasn't 100% FU money. I knew I had to go back to work. I would have to go back to work at some point, but it was nice. Oh boy. All right, there we go. Pulverizer says he's got 10 years to go before he retires. I want to be a financial advisor as a career. I just got a job at a local RIA firm. Any advice? I tell you, yes. I would advise against that. I mean, I know you just got it, so just take this with a grain of salt. The best training I ever had was at call center environment at Vanguard, and then was at a bank. The best financial planning training I ever got, because everyone has debt. And then on top of that, a lot of people have, we'll call the call center, that are all kinds of different people, all kinds. Some got money, some don't, everyone in between. And you just got to learn how to talk to people, man. And once you talk to these people long enough on the calls, when I was at Vanguard, I was taking 150, probably 130 calls a day. Once you see the same questions over and over and over again, you know what is important to people, regardless of their millionaires, regardless of their, people like me who don't have two wooden nickels to rub together. You'll know. And the same thing with a bank, you'll see what most people are living with. And in the RIA world, they're not going after most people. They're going after those with over 7 figures who are willing to pay, $10,000 to $20,000 a year in investment management fees. And those days are coming to an end. Could not be happier. I can't wait for that day to come to an end. I just don't think so our RIAs, they're not there to train you, brother. They're there to freaking get you to work with their clients, to retain the assets, to show them why your client should pay you $18,000, $20,000 a year, and for you to go out there and get new assets. That's not the training you need, man. It's not. The training you need is how to listen, how to be an effective advisor, how to present things that people can understand and relate to. And at an RIA, which is a registered investment advisory firm, as an IAR, an investment advisor rep, you're selling investments. Those days are coming to an end. I think I'd go get a job in a bank, go work at a call center like Vanguard, Schwab, or some of that, Fidelity. Learn the ropes that way for sure. That's what I would do. Just my advice right there. And then I subscribe to Nick Murray's newsletter, Nick Murray Interactive, which I don't have any copies here. I think $350 a year, Nick Murray Interactive. Get the, I can't remember if I have it back there or not. You see my new pillow, by the way, over my shoulder, Maine. Oh, Pablo's sniffing. No, that doesn't have a smell, Pablo. But Nick Murray Interactive, $350 a year. He's got a book called The New Financial Advisor. That's from 2003. Must read. Tim T says he's counting down the days. Right on, man. Al says Wellesley's only $1 down, but $1 down on 50 cents, Al. Well, I'm not sure what Wellesley trades at, like 31 or something like that. Let's keep going. S&P futures are currently down 2.22%. The market goes up and the market goes down. Yep, absolutely. In fact, it's funny. I was telling on the video I did this morning that if you had missed this down market, you're loving life, but most likely you also missed the 35% ride that we've had from the day after Christmas 2018 until basically Valentine's Day. So yeah, you might have missed a 15% decline, but you also missed a 35% up. You got to get the ups. Only way to get the ups is to be in the market. That's all there is to it. All right. So a fellow told me on Saturday that his wife was on a hold with Vanguard for an hour and a half. She wanted to sell all her stocks, but there's a big line ahead of her. Yeah. Vinyl Earthlink says he was 42% in stocks. Now he's 39%. I'd be taking bonds off the table, man. I tell you. So look at this. If you look at, and for those of you who are new here, if you're wondering why I have this dog here, because this is my mastermind, Pablo. This is Pablo. We can't really see him. He's the queen of my double wide trailer, and he runs this house. All right, so there's a Ginnie Mae. That's a USA. That's the USA government bond fund. You can see over here the increase right there. I mean, that sucker has jumped up a lot. And so what I'd be doing, I'd be selling bonds right now and rebalancing the stocks. That's what I'd be doing without question. I have no bonds, so I can't. But if I had bonds, I mean, Ginnie Mae, or not Ginnie Mae, U.S. government. Well, actually, what is a Ginnie Mae? I thought I had the Ginnie Mae on here. Hold on just a second. BFI. Ginnie Mae. Yeah, so here's the Ginnie Mae. Same thing it's on this side right over here. That's recent. And you can see that's way up. So that's up from I can't even tell. That's up what 10% or something like that. That's a big deal for bonds. It might even be up more. I can't tell, but that's up double digits. I'd be selling bonds like crazy, taking the profits off bonds without. Look, man, I'm telling you right now. People say, but you hate bonds. You should never have bonds. Yeah, I agree. You should never have bonds unless it's Ginnie Mae, CDs, or cash. But if you do have bonds and you're not selling right now, government bonds in particularly, I think you're making a huge mistake. I think you're making a big. What is the? Hold on a second. What's the aggregate bond doing? Oh yeah, so there's the. I'm not sure what corporate bonds are doing right now. I have no idea. I would imagine if corporate stocks are getting tanked, I imagine corporate bonds would be too, right? I mean, why would bonds be? Why would it be? Why wouldn't they suffer from stock price decline? I don't know. But anyway, let's keep going. All right, let's see. What other questions we got? Oh, my man James Powell says the media is making it hard to watch daily. Oh hell, man, that happened to me a long time ago. That includes Fox News too. I can't take any of them. It drives me crazy. I literally sit there and say, oh, I can't take it. My wife's monthly salary contribution goes through the stock. Oh, hey, I want to make a point here real quick. I've had a number of questions on this. Josh, if I roll over my 401k, they're going to cash it out. Oh, there you go. Oh, okay. There you go. Hold on a second. Let me see where my king goes. Good. Wow, what a good boy. There you go. Good boy. There you go. Go to Pablo's bed. Pablo's bed. Good boy. What a good boy. If you roll over your 401k, it goes over as cash. They cash it out. And it sits in cash until it finds its way to your IRA. And that might take 3 days, might take 5 days. I doubt it takes much more than that. That means you're out of the market. I mean, without question. So you're selling it because you have to. I mean, you actually don't make the sale. The company does. They sell you out and they put you and they literally cash out. It means you're out of the market. All right. Well, should you do that? Yeah, you should. If you're rolling it over, why would this be any different than any other time? Two things are going. Well, only one of three things is going to happen when you're in cash. So you got $100,000. It was 120. Now it's down to $100,000. All right. They sell you out because they're going to roll it over to Vanguard. And it's going to come over in cash. One of three things are going to happen. The market goes up, in which case you're out of the market. Sucks. You missed out some of the gains. Market stays flat, in which case, what to do? Or the market goes down, in which case, the money goes over $100,000 and you missed out on some losses. On any given day, my friends, it's like, was it 53% of the time it goes the market, maybe 55% of the time the market goes up, 47% of the time the market goes down. I mean, so the odds are against you, making out. But the facts are, if you look historically, there is something called trends and momentum. Momentum breeds momentum, and so the market falls, and then something happens where it just changes. But we don't know when, where, how that's going to be. So for those of you who are considering rolling over your 401k, but are worried that you're going to miss the market jumping up, that's just pure market timing, because you're like, well, I'm going to wait till the market jumps up. Okay. And the market can continue going down. And I mean, why? Look, man, at the end of the day, 3 or 4 days isn't going to make or break you. I talk about the charts all the time. It says, if you miss the top 10 days of the market, you missed out this, that, and I get that. But why? That seems to me it seems absurd to say I'm going to wait because the market might go against me while I'm out. Well, it could also go for you while you're out. So I just don't market time. Just be done with it. I'm rolling it over. If I miss out, 5% upside, that sucks. Not likely to happen. Very unlikely to happen. Could, but you also can miss the other way too. In that case, it's not quite a crapshoot, but it's getting pretty doggone close. Yeah. Oh, Pete Buttigieg dropped out. Sweet. I never liked that guy, man. That guy just annoyed me. It's like, just stop. Super Tuesdays in 2 days. Mayor Pete dropped out of the presidential race. And we got Sleepy Joe and Crazy Bernie. I'm surprised Buttigieg didn't hang on through Super Tuesday. I thought he would have. His fundraising must have just dried up. That's interesting. My man Jerry is buying PPL and PFE. Let's take a gander. PPL. And by the way, dudes, guys and gals, I do this every Sunday at 7 p.m. If you're wondering why we are doing this early, I changed it to 7 p.m. It was 8, then it was 7:30, now it's 7. I like 7 because I look at the clock, it's already 8:32. I still got all kinds of energy. So Jerry's buying PPL Corporation, which is a pipeline. All right, there you go. Sweet. And then he's buying PFE. All right, PFE, which is Pfizer. All right. And then don't forget, in case I see a bunch are watching now, Andrew Biggs will be joining us live on person or in person next week, 1900 hours Eastern time. And for those of you who don't know your military nomenclature, that's 7 o'clock Eastern time. So Andrew Biggs will be here fielding questions. The people on my Subscribestar who support my work, $10 a pop, are going to get all their questions answered. I mean, as long as they're not freaking insane. How do you wear tighty whities or boxers or something like that? But they'll get their questions answered first, and then if you want to hear what they ask and then ask your own questions, we'll do our best to get to them. But I'm looking forward to that, man. I'll refer to this quite a bit. How do you go on Subscribestar to remove $10 a month from your wallet to my pile of gold? It's just Subscribestar, like it sounds, Subscribestar.com/ actually let's just go there, shall we? Am I still sharing? I think I am, aren't I? Let's see, hold on a sec. Oops. What happened? Oh, there we go. I am still sharing. Okay, there you go. So let's go Subscribestar right here. So shameless plug for you all to give me money. You ready? I'm going to go to Subscribestar.com. Here. All right, so this is my Subscribestar page. I do not use Patreon. And the reason I don't use Patreon, because those guys are clowns. They took away some people that are not right-wingers, alt-right guys. And that's the wrong answer. And Jordan Peterson and Sam Harris. Sam Harris, the big atheist, both took their Patreon channels down, which is why, look, man, I'm a Christian. I don't have any issue saying that whatsoever. I love Jesus. If loving the Lord is wrong, I don't want to be right. But a guy like Sam Harris, I respect, and Richard Dawkins. I mean, I think Richard Dawkins is probably a little bit over the top. I think he does that deliberately, but I respect him. They don't just come after Christians; they come after everybody. I think Sam Harris is a lot more even keeled than Richard Dawkins, frankly. But then you look at our side, we get a lot of crazy guys too. So at the end of the day, I respect that Sam Harris has the guts to take on all, as opposed to just Christianity. It's so easy to bash Christians, man. I mean, you get a freaking, you know, you get a red badge or whatever's a red star for bashing Christians. Like, oh, you're so brave. Give me that's yesterday's news. Try doing something else. No one's got the guts. But anyway, so Jordan Peterson and Sam Harris, among others, went away from Patreon and went to subscribestar.com. And as you can see here, this is my page. So subscribestar.com, Josh Scanlon. I got 51 subscribers. I meant to do a live stream last week. What happened? I forgot. I think Liam had a basketball game or something like that. I try to do a monthly live stream here. I'm just kind of trying to figure this out, frankly. I got 51 people who pay $10 a month, man. So that's $510. Much obliged. I mean, I cannot tell you how grateful I am. I say thank you for helping spread the word and stick it to the censors. But anyway, priority for Q&A, like we just talked about. I do my best to answer all the messages. I get on here a couple times, probably 5 times a week. I will post some stuff on here that I don't post on YouTube. Not a lot, frankly, not a lot, because I just like the YouTube stuff, but I do post stuff on here. I think I've done a couple videos for Subscribestar, solely for Subscribestar. They didn't work out the way I was hoping. They didn't come through the way I liked, so I'm not sure I'll do that. But I will write some stuff on here that I don't post on YouTube. I do get a little bit more political on Subscribestar, because I hate the commies, and I will share it more on here than I do on YouTube, even though, I just said it on my YouTube channel. I hate the commies. Hate's probably too strong of word. I highly dislike communists and all they stand for, and you should too. Secondly, but I do have, like I said, I'll do a live stream once a month on Subscribestar. It might be more as I go forward. It might be less. It won't be less, but might be more. We shall see. And the nice thing with Subscribestar is you can actually call in. It's a call-in chat show, and which is kind of cool. But anyway, people ask questions on Subscribestar. I do try to make it a priority to answer those questions for sure. I can't say I'm perfect on that, my friends, but hell, if people are willing to give me $10 a month for nothing else, just my pretty face, the least I can do is try to put these to the top of the queue, if that makes sense. So there it is. There's my Subscribestar page. Pretty cool. I like it. I'm a big fan of Subscribestar, and you'll see. Sorry. This post belong, you see, and I said, don't forget to send me any questions you want me to ask for Andrew Biggs. Anyway, let's see. I think I posted this one on YouTube actually. So anyway, so there you go. If I did post that one, anyway, there you go. So I'll stop that now. All right, cool. Let's go back here, stop share. All right, see what else we got. Dan's in the house. What's up, Dan? Ooh. I'm not sure if Dan's still on here. Dan, I would like to use your holdings, not saying how much you have or anything, if you don't mind, for a video. My man Dan had a wonderful portfolio with 3 buckets. I gave him a couple thoughts on a couple of the buckets, but I tell you, man, I thought it was fantastic. The drawback, but he's anal enough to be able to manage it. I think a lot of people would not, because he didn't have a huge amount of holdings, but he had more than just a couple. And I think that'd be tough for many people to manage. I do. The only reason I say it is because I've been in this business so long. But I think from a Vanguard perspective with ETFs and mutual funds, the 3 bucket approach it'd be tough to beat Dan's coming up the way he did it. And I think I emailed you, but if I could use not your recommendations, what you are looking at for yourself to share with other people, I think that's a model portfolio. Absolutely. I think it's fantastic. So anyway, Dan, hopefully you got that email. If I didn't send an email, hopefully you got this. You're still online here. Look at the price performance of the Dow after the spinoffs. So when they let a company go off to 30, the rest of the Dow suffers, or the companies that were on the Dow that get kicked off suffer. I'm not sure what you mean by that. All right. Okay, Dan says, all right, sweet. All right, cool. Oh, hold on a man, I missed a bunch here. Sorry, guys, I missed a bunch of. There's a guy in here, Sam S. Man, I love this guy. Sam, you are my man. That's all I gotta say. Sam, man, I, I just like people who don't agree with you. I mean, it's okay. It's like I just, oh man, it just cracks me up. Um, Sam's a Biden guy. He doesn't like Bernie. I don't like Bernie. He's a Biden guy. That's cool. All right, so I missed. Here is Deborah Miller. I think I missed here. Josh, I have 3 whole life policies. Would I cash in one to pay off the mortgage? Ooh. All right. Whole life. Look, man, I don't know why people think I'm anti whole life. I am not anti whole life. I'm anti universal life. I am anti universal life. I'm not anti whole life in the least. I'm not a big fan of the infinite banking concept. It won't work. The thing with universal life and whole life is that it was a hell of a lot better a long time ago when the rates are higher. No other way around. If you have a policy that you're not putting much money into, neither of these policies are going to do much for you because the rates are so low and the cost of insurance is going to eat up the premiums. Just all there is to it. The nice thing about whole life is it's there literally for your whole life. That's why they call it whole life. So whole life will give you there'll be a higher premium to you, higher payment that you have to pay in return for a guarantee. I mean, the insurance company's taking on the risk. That's just a fact. But because you're transferring the risk to the insurance company, you're going to have to pay for that. But if you can fund these policies, if let's just say you're a 35-year-old entrepreneur making bank, I mean, even a universal life at that point looks good to me. If you can fund those suckers well. And when I mean fund, now whole life is different than universal life. You got to be careful on MEC contracts. MEC is modified endowment contracts. I'm not going to get into that deeply here. MECs are not that big of a deal. It just makes a MEC look like an annuity for the cash value. That's literally all it does. So if you MEC it, a modified endowment contract, you are now turning your ability to borrow against the policy and to take money out before you're 59 and a half. It works just like an annuity at that point where you can't borrow against it. You have to take distributions, which are completely taxed as OI, LIFO, last and first out. And on top of that, if you take it out before 59 and a half, it's taxed as a premature distribution, just like an annuity. So you got to be careful there for sure. If you MEC it, if you don't MEC it, then it's gonna be hard to get a lot of money in there. And that's the issue here. Now there's lots of different ways you can maneuver around these things to increase, decrease the death benefit, all kinds of different things you can do. But the more modifications you make to not MEC it, to give you the flexibility to take money out before you're 59 and a half, the more premiums you're gonna have to throw at the contract. The more premiums to throw at the contract, the less money you have for other things like just good old fashioned dividend paying stocks. So look, I got whole life policies on all 4 of my kids. I got 2 $50,000 whole life policies on each of my children. In fact, I think I even have right here. Knights of Columbus. I have USAA and Knights of Columbus. Knights of Columbus is a Catholic fraternal organization, dividend payer. So here, I'm going to show you. I'm not going to show it to you. Unfortunately, I had to sell my agent to sell me on these policies because this is the problem with people making second careers in financial services. Sometimes they don't know what they're doing. And I found that with Knights of Columbus, some of these agents just don't know. We actually had a second and die life policy with Knights of Columbus, which I since cashed out last year or 2 years ago to help fund my business. And the guy had no clue what it was. And that's the problem dealing with rookies is that they don't know what they don't know. And if they're older, some of these guys, they don't take the time to learn, if that makes sense. That's the issue I have with the second career financial advisors, like Ed Jones, Merrill Lynch. They really recruit among corporate types to become financial advisors because they have these huge Rolodex of people that they call on. And my concern with that is some of these guys have been, mid-level, high-level management for so long that they're used to barking orders and people listening as opposed to asking questions and learning. And just this business is something that you just have to be able to take pride and not be so proudful and just be able to learn. Anyway, so here we go. So here's a 20-year pay whole life policy that I have. This is on who do I got this on? This one right here is on my son Kevin, my third oldest. All right. So we pay $21 a month every month for 20-year paid up. Well, that means after 20 years, this thing's paid up. There's no longer any more premium, and it's guaranteed. It'll never go away. It'll never go down, and there'll still be cash value, most likely accumulating, simply because it'll have these paid up additions, PUA, with all the dividends that we essentially reinvested dividends in the policy. All right, so we got death benefit right now of $25,000. That's the face amount, but we got basically $967 in paid up additions. We've been paying $21 a month since 2013. So that's 7 years. We're now 7 years into the contract. So we got 13 years left before this thing's paid up. We have cash value of $930. All right, that's our cash value. So if I were to cash this out today, I'd have $930. But I've also built up $967 in an additional life insurance. Does that make sense? That is confusing all it can be. But if Kevin were to die today, we would get $25,967 of tax-free life insurance, even though the face value is only $25,000. I hope that makes sense. We've been paying $250, basically what I say, for 7 years. We take our trusty calculator and we do $250 for 7 years. We've paid $1,750, and right now I have $930 of cash, and I got $967 of paid up additions. What that means is, whole paid up additions whole life. So essentially, this hasn't cost us any money, if that makes sense. We paid $1,750. Right now, we got more than that back in terms of the accumulation of our dividends and paid up additions on whole life. It's not quite tit for tat, but I hope that makes sense. So essentially, I don't want to say it's free because there's an opportunity cost, but that's how it works. You pay up you get paid up additions, and you get cash value as well. So you have two things going. You got your paid up additions growing, which is just further life insurance, and you got your cash value growing as well. So what happens here is in 13 years, I no longer pay any premium. I will, at that point, I have no clue how much cash I'll have in this. I could get an in-force illustration, which would project how much cash I'll have in there. I'm not going to do that because I'm not going to stop paying these guys. I keep paying, basically $250 a year. Anyway, so in 13 years, Kevin will be 26 years old. And I'll say to him, I'm going to either gift him this policy, and he can cash it out if he wants. I don't know what the cash value would be, a couple $1,000. Or I'll just sit on it and allow it to keep growing and keep growing and keep growing and keep growing. That's the thing with whole life, man. You can keep adding to it. You can do whatever you want with it. And you just got to watch the rules and regulations of whole life insurance. But if you can fund it on the front end while you're in good health, you can make out like a bandit on some of these whole life insurance policies. Think about it. Last year, we made $140. Actually, I can't. How much did it make last year? Last year, I can't remember. I can't remember. Off the top of my head, I can't remember how much we made. I'd have to look at my statement previous to that. Either way, last year, we'll just say we made $150. I'm just using that for example. That's tax free. You don't have to pay any tax on that. None. We made it. If we cash it out, no, it'll be less on our basis, so it'll be tax free. Anyway, I can't remember exactly how it works because I don't really care all that much. But there's some significant benefits on whole life insurance that you don't get with universal life. On top of that, you don't even really get with dividend paying stocks or anything like that, because whole life it pays dividends as long as participating. Those dividends are tax free. Dividends get reinvested. It's just, and they're guaranteed. You got a guaranteed minimum. You're never going to hit this. You're never going to hit a home run here. But so in 7 more years, actually 6 more years, 5 more years, my USA policy will be paid up. And the same thing, I'll have $100,000 of life insurance for all my children paid up, no more premiums to pay, and they're just going to grow. I see, I'm a big fan. So going back to you, Deborah, it depends on how old you are, how much cash you have in there, and what your death benefit is. It depends on also what the guaranteed investments are. because there is a guaranteed minimum that they can't break. They cannot go below the guaranteed minimum. Lastly, I'm going to just share with you. I came up from the Vanguard school. All right. Came up from Vanguard, read Bogle before I even got to Vanguard as an employee. I'm very familiar with the buy term and invest the rest. I'm very familiar with that concept, and I disagree with that to some degree. And here's why. About a year into my tour, if you will, at USAA, I met this guy on the phone. This is before we got to face-to-face meetings, and he had a policy. I can never remember how much he had, but it's like $3.5 million of cash value in a policy he took out in the mid 80s. It was an executive policy. It was a highly compensated executive policy. I can't remember what it was. Life insurance, employee COLA, company-owned life insurance, Colby. I can't remember. But anyway, he owned it. Long story short, it's like $3.5 million with a $5.25 million death benefit. All right. So he could either die, his wife would get $5.25, 100% tax-free, or he had $3.5 million that he could take out. He could take it out in bits and pieces. He could borrow. He could do whatever he wanted. It was nuts. Essentially tax-free. You got to be very, very careful there. Just be advised. I'm not going to get into that. But anyway, so he had $3.5 million essentially to his taking tax-free. It had a guaranteed minimum of 5.85%. Guaranteed minimum. Tax-free flipping growth. Guaranteed, because he took it out in the 80s when the interest rates were high. And the USAA said back then, as every insurance company did, we are going to give you a guaranteed minimum of 5% because no one had any idea what would happen to the interest rates. 5% seemed like freaking crazy man talk back then. If we ever went below 5%, there'd be riots in the street. Because remember, back then, the 30-year treasury was paying 15.25%. So no one ever thought it'd pay 5%. But they also gave you, if you had a certain amount of cash value, they gave you premiums. So he had an 85 basis point premium on top of his 5%. He was literally making 5.85% guaranteed by USAA, one of the strongest insurance companies out there, tax-free. On top of that, if he did not want the cash and just let his wife get it, tax-free. No one can tell me that's a bad policy. No one can sit here and say whole life, in this case it was universal life, is a scam. That'd be stupid to say that because it wasn't a scam. It was incredibly fortunate and lucky. Anyway, the point is, don't be so quick to pull the trigger on your policies, guys. You got to look into them. Now, if you took them out in the 2000s, they're probably crappy. I'm not going to lie to you because the interest rates are so low right now that they're unless you stuff that with a huge amount of money, they're going bankrupt. They're going to go, I should say that. They're going to go kaput. No, they're going to, they're not going to stay in force. That means they're going to, I don't know what the word I'm looking for. I hate to say bankrupt. It's not the insurance company. Your policy will expire before you do, which means all that cash value will be gone. You won't get a thing from it. And you can't have that happen. But that's going to happen to a lot of these policies that were issued in the mid 90s and beyond because the interest rates are so low. Not good. If you had a policy issued in the 80s, I'd tell almost everybody, if you have a policy issued in the 80s, you shouldn't have canceled that sucker. Just keep that in mind. I did a video on this a couple times now. Had a doctor at USA, nice guy when I was in Philadelphia. He lived in New Jersey. And he came in one day. He had $80,000 of cash value on $1 million universal life policy. And this was a B. I can't remember. It was A or B. And I forgot. But anyway, he had $80,000 on $1 million policy. He was 66, 67, something like that. And because I always did my preparation before meeting with people, I did a quick in-force illustration to see how the policy was, how strong it was. And an in-force illustration is not your statement. This is a statement. That was not a statement. An in-force illustration projects guaranteed minimum interest, current interest, guaranteed minimum expenses, and current expenses. It projects that going forward to see how the illustration would last, the policy would last. It's called in force, like I'm going into the store and the force be with you. So in force illustration. Everybody should get an in force illustration if they have any kind of cash value life insurance. All right, so long story short, we get an in force illustration. I did it, it's easy back then. And I don't know why USAA doesn't do this. No insurance company sends you an in force illustration. It freaking drives me insane. Long story short, that policy was going to expire. And by the time he was 77, I believe, he had 10 years left. And he wasn't going to die by the time he was 77 because he was in good shape. I remember telling him, Dr. Smith, I remember this guy like it was yesterday. I said, doctors, and he was not a happy camper. I said, yeah, $80,000 in this policy. I can't remember if he's still making premiums on it. I think he might have been, actually. I think he's still making like $250 a month premiums. I said, this policy is going to die unless you die before you're 77 years old. I remember looking at him and he was just like, he wanted to strangle me. And I said, what happened was you bought the policy in the early 90s when the interest rates were much, much higher than they are today. And their projections back then were on interest rates in the 6. Now they're in the 2.5. And they've been in the 2.5 for the last 10 years. And they're not going up anytime soon. So a couple of things are going to happen. You're going to have to either make a significant contribution to this policy, you're going to have to reduce the death benefit, or you're going to have to hope that interest rates go up and expenses go down. Expenses aren't going down on a life insurance for a guy who's getting older because it's more likely for him to live. There's something called COI, cost of insurance. COI increases each and every year. The reason for that is because as you get older, you're more likely to die. It's crazy. If you eat carrots, you'll die. Do you hear that? If you eat carrots, you will die. So his cost of insurance is going up, his interest rates are going down, and it's just taking up that cash value he's got. His cash value is dropping each and every year. So he looks at it, says he has $80,000. He's looking, thinking he's good to go. No, sirree, Bobby. He's not. Anyway, I forgot what we did. I think he had a municipal bond fund that's paying like 2.25. It was a municipal bond fund that's paying 2.25. And the life insurance, I think, had a guaranteed minimum of 2.5, if memory serves. I can't remember. This is 8-9 years ago. And we moved that municipal bond fund like $500,000. Maybe it wasn't that much. I can't remember. We moved a significant, well over 6 figures of that municipal bond into the life insurance. A, to keep it strong. B, because it's paying more of a guaranteed interest rate than the municipal bond was for sure, because there are no guaranteed interest rates on municipal bond. On top of that, the life insurance grows tax-free. I mean, he can borrow, he do whatever he wants with it. Again, there are some caveats. You got to be careful, but generally speaking, I said, look, you got $100,000, whatever it was, in this municipal bond paying 2.25. We could take that money out. It's not taxable gain. There are hardly any taxable gain in municipal bonds. You can move that over to life insurance. They'll strengthen the life insurance policy. It'll increase it'll give you more of a yield for sure. And you're more likely that if you were to die, now the policy won't lapse until you're 92 or something like that, which at that point you'll probably be dead anyway. And so now your wife will get the $1 million, I think I can't remember, but it's like $1.2 million or something. And he said, yeah, let's do that. The whole point of that is if you don't get the in-force illustration, you have no clue what your life insurance policy is doing. Unfortunately, most people don't get in-force illustrations. Unfortunately, most insurance companies don't send them out. And unfortunately, most advisors have no clue what the hell it is. And because of that, everyone's sitting out there. I bought this from little Johnny when he first got his job at Prudential, and he said it was good. And he looks at it now, nope, not good. So long moral to the story. Don't just pull the trigger on your whole life insurance unless you know what you have. Just because you says his whole life does not mean his whole life. It might be universal life. And if it's universal life, that policy is very suspect to me. Whole life and universal life are two completely different things, my friends. Do not confuse the two. They're not the freaking same thing. They're not. Whole life is not universal life. Universal life is not whole life. They're completely different. They're both cash value, permanent policies. Permanent insurance means they'll be there permanently until you die. But there's a huge caveat in there. As long as you fund it correctly. And funding it correctly means understanding the cost of your insurance. As you get older, it costs more, and the interest rate cycle that we're in. So for it to be permanently funded, well, doggone, you better make sure that you got enough money going in there for sure. And no one does that. It's nuts. Crazy. All right, so let's keep going here. Yep. So Lon says, can you do Ross at any time? You can do Ross whenever you want. Roths are one of the exceptions to the 10% premature distribution. Absolutely. Meg says she loves that I'm on a dividend kick. Um, yeah, right here, Tom. Buffett loves dividends when someone else is paying them to him. Yeah, exactly right, man. Tom Major. Even some people from Maryland got a brain. Hard to believe, right? I went to high school in Maryland, so I can say that. Um, Obsessed DIY likes a VYM high dividend ETF. Right on. Meg's from Massachusetts. She loves I'm a dividend kick. I'm always on a dividend kick. Sometimes I just get these things in my head, Meg, to say I want to focus on this more. Like I was focused on the Dave Ramsey thing the other day, and I just didn't want. What happened? I was just trying to show that Dave Ramsey stuff was nuts in this regard. And then all of a sudden I said, I started watching 2 or 3 more of his videos that people sent to me. And I said, I can't believe this. I can't believe it. And then I get on the kick where I was like, and then I just said, that's too much. I had to back off of that. So I said, I don't want to come across like I don't like the way it made me feel, to be honest with you. I said, that's not what I want. Dividends, on the other hand, I get in this little of a kick on dividends and, or, other things. I just, it's just like it takes over my brain for a couple of days, and then I move on to the next squirrel. Mike says, it was a running joke with wife and I when I turned 50. I'm in AARP. Why can't I retire? My man Vinyl Earthling says my dividend portfolio was paying 4% on Monday, is up to 4.6% on Friday. Man, just be advised, folks. Just because a dividend yield is high means nothing. It doesn't mean it's a good or bad buy. It doesn't mean anything. And I think what Vinyl is saying here is that prices went down. Dividends stay the same, prices went down. Thus, relatively speaking, the dividend yield goes up. Is that more of a buy than it was at 4% dividend yield at 4.6? Well, yes, it is actually. Why is it more of a buy? Because of higher dividend yield? No, because the prices are down. It's the same dividend is paying. The dividend itself is paying the same 50 bucks a share, whatever it is. It's not because 4.6 is a higher dividend yield that makes it attractive. It's because the price went down. It's a seesaw, man. So here it is, even Steven, 4% dividend yield, 50 bucks a share. Dividend yield 4.6, 45 bucks a share. This is inherently better buy because it's cheaper with a higher yield. But the reason it has a higher yield is because the price has gone down. It's literally that simple. Don't get caught. I get this all the time. Should I buy this real estate investment trust or BDC, Business Development Corporation, that has a yield of 8%? Man, if it has a yield of 8, it's not growing. It's a junk bond. It's no other way around that. You're not getting growing dividends. I want growing dividends. I don't want high yields. I want growing dividends, which means companies have potential for cash flow to keep the dividends going, to grow and grow and grow. Just like we did in the ICA guide I did a few minutes, about an hour ago. The ICA guide, the Investment Company of America, just shows you the value of growing dividends. I don't care about the high dividend. I don't care about that. I want growing dividends. That's why I love the Vanguard Dividend Growth Fund, VDIGX, which I own. I approve this message, whatever it is. I own that. Disclosure, I own VDIGX, so no one should buy it. But that's why I like it, because it's not just that it's high dividends. I don't care. It's growing dividends. Growing dividends is what you shoot for. Oh man, there's my Maryland guy, another smart Maryland guy. I think Fear the Turtle's a big Bernie guy too, a big Biden guy too, like my man Sam. So Fear says just move from Sprint to Consumer Cellular, and he gets a 5% discount. Right on. Ooh, Tim says rental real estate holding up fine. That man, rental real estate holding up fine. I got no qualm with that. I don't want to be a landlord. Hell, I can barely freaking fix my stupid garbage disposal. You know what I'm saying? But I did it. I certainly don't want to go some freaking crazy drunk guy's house in the middle of the night trying to fix a garbage disposal with Pablo freaking barking at me, nipping at my bud, saying, "Give me a freaking food. Give me food." I say, "Pablo, you're freaking 12 pounds, dude. How much could you possibly eat in any given day and not put on weight? When I just look at food, it just falls in my belly. I don't have to eat it. It just gets me fat." You remember when we were young and we could eat like freaking crazy men and not get fat? Oh, yeah. I could eat, man. I could eat like crazy. I remember going to Burger King and just eating like 2 Whoppers, drinking freaking a 6-pack. This is before I knew what Sierra Nevada was or Guinness. A 6-pack of what did we used to drink back then? It wasn't Old Milwaukee. It wasn't Pabst. I can't remember what we used to drink. Coors. I've always liked Coors. Yeah, that's what it was. Coors. Always liked Coors. Drink a 6-pack of Coors, eating Whopper, fries, freaking shake. Yeah, I think I just put 5 pounds on just talking about it. Nuts. Yeah, that's right. People aren't going to stop renting because of coronavirus. By the way, my wife gave me this cut. If you're wondering how my hair got so beautiful, I went up there. So I started this at 7 o'clock. I went up there to get a cut at 6:45. 5 minutes later, I come back looking fresh for 88. Fresh. Look at that cut. Who's got the best wife ever? This guy. Even though she yelled at me today because I trimmed my crepe myrtles down there. I trimmed them. She goes, "You're gonna kill the trees." I said, "No, man. On crepe myrtles, you gotta trim them. You prune them." She goes, "No, they look ugly." Anyway, so we're driving to the baseball game in Gwinnett County, and all the landscapes had their crepe myrtles pruned down. And I looked over. I said, "Oh man, all those guys with professional landscapers, they're gonna kill those crepe myrtles all over the highways." And she goes, "But they look ugly." I said, "But that's not what you said. You said I was going to kill the trees. You didn't say they're ugly. Now you're changing it when you know I'm right." Gotcha. And then I have my air compressor jump starter thing in the back and it's kind of bouncing around. She goes, "Everything, you don't take care of anything. That's going to break and scratch up the car." I said, "It's not going to break. It works just fine. I drove it like that all the way down to Ford and back." She goes, "You don't take care of anything." But when it came to the garbage disposal, guess who she came to? Did she go to Pablo? No, she went to me to fix it. And trust me, I'm not that mechanically inclined, but I still did it. Who did she go to? Me. When one of my boys overstuffs the toilet with all kinds of toilet paper and other stuff, does Charlotte take care of it? No. Who does she go to? Me. I wouldn't trade it for the world. All right. Delaware John here. All right on, man. Delaware John, I did a video on some 55 plus retirement community right outside Rehoboth Beach. I was telling my wife, Lori Morgan. I remember Lori Morgan. She was good. I was telling my wife about that video. I said, "Man, would you ever want to live in a 55 plus community?" She goes, "Yeah, maybe." I never thought about it, but who knows? Pulverizer going to bed. Rob going nighty night. Yeah, freaking Massachusetts guys, they can't keep up, man. Mark's from Maryland too. Well, we got 3 Maryland guys on here. We got Fear, we got Mark, and we got Tom Major. Northwest of Baltimore, right on. All right, let's see. Anything else on here? Are you in? Okay. Hey, man. Shable, his name is known in St. Mary's. Yikes. That might be a bad sign. Meg says, "Do more in the single." Yeah, Meg, you got it. Absolutely. Investment tax strategies for singles. That's what we're going to do with Anne Marie. All right, people making friends on here. People making friends on here, man. Freaking love it, love it, love it. I appreciate y'all being here. Just real quick, I do. I do appreciate y'all being here. It's I enjoy it immensely. It's pleasant. I get some cranks on occasion. Actually, I think Tom and Jerry are again. Tom and Jerry, those are my 2 moderators. I think they're doing a good job policing up the fools, and I'm much obliged to them. But just everyone who wants to hear me, I just freaking, it's nuts, dudes. My man Sergio on here, Al, all kinds of people on here. It's all good. Vinyl Earthlink. Vinyl Earthlink says you need to throw in good business model and good management to properly evaluate stocks. I couldn't agree more. I don't want to do all that, though. That's my issue. I don't. No appeal to me whatsoever. None whatsoever. But I agree. If you're going to buy stocks, I think individual. I think it's a random walk. Just go to Bert McKeel, random walk down Wall Street. I don't think you can. it's luck. Someone's always going to be the better of luck. Someone's always going to be the worst, for sure. There's always going to be a Buffett. There's always going to be a Peter Lynch. There's always going to be a what's the internet.com guy? What the hell was that guy's name? I can't remember. He started a hedge fund too. There's always going to be a Hillary Clinton's, Chelsea Clinton's husband, Margovich or whatever, who freaking bets on Greek debt or something like that. He doesn't know his butt from a hole in the ground, but he's got connections. But there's always going to be losers. There's always going to be winners, but more is luck. I mean, as much as I can't stand Chelsea Clinton's husband because he's a swamp creature, or Hunter Biden, and the facts are they could get lucky. I mean, they could get lucky. Just Chelsea Clinton's husband, Margolovich or whatever, he got bad luck. But he would never have been in the place to begin with if he didn't have the political connections. Do you see the thing on Hunter Biden in the New York Times? Apparently they did a puff piece on him as an artist. He's renting a place in Hollywood at a 12. So it's funny. Some guy said a jobless man rents a 12K a month apartment in Hollywood, converts a pool house into an art studio. Man, I'm not doing the justice the way this guy was talking about it. It's funny. He's like homeless, jobless guy. That's how I don't get how my man Sam S can support these people, man. I don't get it. And see, this when I hear white privilege, I think of guys like that. I got more privilege than most people in the world. It's not because I'm white, it's because I'm an American for sure. Do I have privilege from previous generations not being held back? Absolutely, absolutely. I make no apologies for that whatsoever, though. I don't hold it into contempt. I don't hold it in pride of who I am, where I'm from. I don't hold any of that. I just say that it is what it is. But when I hear white privilege, I see it with guys like Hunter Biden, Chelsea Clinton's husband, the Bushes. I mean, all these people all running the same group. They're all swamps, man, all swamp creatures. Hell, you can say the Trumpster guys, all that stuff. But at least Trump's, I mean, no, you got to throw him in there too, man. All swamp creatures. But there are black guys, Spanish guys, all that, who got that same type of privilege. And I know because I actually did the carpet cleaning for one of those guys in DC when I was living up that way. And I had a job in the morning cleaning carpets, going to school in the afternoon, and working my bar at night. Nicest people in the world, don't fault them for anything. But I always get a chuckle at the idea that I had more privilege than this guy. It's just as funny. It's just, I didn't. I shared the story with you before, and I'll share it again. I will never forget, ever, going to this old black lady's house in South DC, cleaning her carpets. Just a very proudful woman, had bars in her windows as everybody did, and I had to park the van, the carpet cleaning van, like a block away, in not a very good part of Southeast. Was it getting better? It wasn't the word. It wasn't Anacostia, but it was becoming rough. If that makes sense. And I remember, I just remember this just beautiful old lady. Just dignified as all could be, very proper. And I'll never forget that lady. And I just remember cleaning her carpets, and she had been there a long time. And I just wish I'd love to interview her, see, and I never would have done that because who am I? But I just always thought, like, I just wish I knew, it would be nice to know what she had gone through. You know what I'm saying? Because I guarantee that lady, I find this horrific, actually, some of the crap that she must have gone through. And but I'll never forget, she was very proud of her house, kept it very proper lady. And just the bars, it was such a what's the word I'm looking for? Just the sweetest, kindest lady you could possibly imagine, with the bars on her window, because that's what you had to do in that area. And I remember she was worried about my truck getting broken into. And I said, look, I mean, I'm just here for the job. It's not my truck. If the guy who owns the firm, he had to, he knows what he's doing. I'll never forget that, though. And then she didn't tip me, but she gave me cookies. And I'm a pretty emotional guy when it comes to my feelings about people like that. Cause it always made me kind of sad. And I just sat there and said, man, just a gracious, young, nice lady. Didn't tip me, though. And I wasn't expecting it. But then I came out to a lady's house, in Manassas, and she had clothes all over the floor. And I always say dirty underwear. I don't know if it's literally dirty underwear, but clothes all over the floor. Had a big attitude, and said, you got to clean the carpet. Said, lady, you got freaking clothes all over the floor. You know what I'm saying? And I'm not picking up your freaking clothes. And she paid me like half. And I said, huh? I'll never forget the dichotomy there. This woman in Manassas, we'll stop it there. But I'll never forget, younger lady, just an attitude like you wouldn't believe, with freaking clothes all over the floor. Said I didn't do a good job. She was only going to pay me half. I said, but you left clothes on the floor. I'm not picking up your dirty clothes. I mean, what do you want me to pick up some of your underwear and wear it on my head to show that's not dirty? What the hell is that? But the lady in DC, and I'll just never forget the dichotomy between the two, and the level of it's all around me versus this woman, the level of just pride. You know what I'm saying? The pride of ownership, and this other lady could care less. It was nuts. It was nuts. I'll never forget the two contrasts. All right. Are 403Bs good to the extent that your company is giving you a match? Absolutely, man. If your company is giving you a match, absolutely. Always take the match. Starling's in the house, man. Catching the tail end right on. There's my man Starling. Dow's going down 50%. Well, if that's the case, you probably don't want your 403B, right? We are due for a session. It's been 12 years. Yeah. Yeah. Tired of Mexico. All right. I guess we will call this. Yeah, we'll call this a night here. Dan Rob's in Worcester, Mass. Yep, you got it. And Meg's in Worcester as well. Meg, you in Worcester? Look, we got Meg, Dan, and Rob in the house. We got Maryland in the house, Massachusetts in the house, Fairhaven. I think that's on the water. Oh, God, Sam, you like Elizabeth Warren? Wow. Oh, Sam. All right. All right. I guess I'm going to cut this off here. Looks like we are good. So again, thanks y'all for being here. Marie Landis from Pennsylvania in the house. All right. I'm going to take old Pablo out, let him take care of some business. Your PA's in the house. You got it. Thanks, y'all. Remember, just real quick before y'all hang up, next week, Andrew Biggs from American Enterprise Institute will be joining us live and in person from his studio office in California with his own dog on his lap, most likely. So if you have questions, send them in the live chat for sure. We'll get to everything we can. Absolutely. We'll stay on until, probably 2 hours, I guess. I haven't confirmed that with Andrew that he could stay on that long. But we'll stay on and get this done. So this will be an important thing. And it doesn't have to be solely around Social Security. Andrew does 7 p.m. right on, Vic. Vic, did you notice how I was holding up this for more than 3 seconds now? Oops, not that. So again, I actually believe it or not. So look, guys, every time I do this now, 1, 2, 3, because my man Vic told me, he said, man, hold up so we can see it. Anyway, the point is what I'm trying to say. Andrew Biggs knows retirement. Andrew Biggs knows retirement more than anybody. That's a fact. Well, it's a fact, but you don't have to just ask about Social Security. If you want to ask an academic about annuities, academics are big on annuities. By all means, do so. If you want to ask about the retirement fear that is not matriculating, but you want to ask about it because you might have your own fears, by all means, man, do it. Anything. If he's not going to tell you stock A to stock B to buy. What does he think about Bernie? By then we'll know. Super Tuesday is on Tuesday. I think Biden's going to take it. I don't think Bernie's going to be the nominee. I think it's going to be Biden. But we'll know. We'll know come Tuesday, come next Sunday. So you can say, what do you think about this? What do you think about that? Andrew knows more than Devin Carroll, and Devin Carroll knows more than I do. And Devin Carroll is one of those guys that knows a lot about Social Security, more than most normal people out there. Andrew knows more than him, which is pretty insane when you think about it. So join us 1900, 7 p.m. Eastern time, and then bring some questions. And if you're on the subscribe star thing, fire me the questions so I can know. All right. Thanks again. Blessings. We'll see. And then we'll see you guys next week. Thanks now.